Domestic Transfer Pricing published by CCH. He has served as a member of various committees of BCS, the ITAT Bar Association, and the Chamber of Tax Consultants. He is presently a member of the Taxation Committee of the Chamber of Tax Consultants. With this brief introduction, I now request Yogesh Bhai to kindly guide and educate our members on this topic and share your views, sir. Please.
Thank you very much, Darak sir. Thank you very much, Mehul. I hope I'm audible.
Yes, yes, you're audible well, sir.
Very, very good. At the outset, I am really, really grateful to Vilepale Study Circle for inviting me to discuss the provisions of the Finance Bill. And Vilepale Study Circle really makes me nostalgic, sir. For the first time I came to Vilepale Study Circle for a budget meet was Pradhiman Bhai, even before Pinakin Bhai had taken over. And then, of course, Pinakin Bhai was there for a long, long time. And in fact, it is the Narsimonji College classroom, next to the next to the staff room, where many meetings in the initial years I have attended. And I have in fact studied in NM College, sir. And sir, you said that I am known by the company I keep of my seniors, but among the seniors, Darak sir, you were also there, because I have studied in NM at the time when you were there. Pinakin Bhai was there, Gautam Bhai was there, Professor M.V. Shetty, Professor Krishnadwala. I studied under all of you, sir.
Thank you.
But I also heard you saying that you didn't have occasion to interact with me, Darak sir. That is because not any fault of mine. It is because of the Narsimonji College canteen. Because I have not attended your many lectures, so you didn't have occasion to interact with me. And sir, you said that last year you missed the lecture, but let me say that I and all of us here missed the expert comments from you, sir. And so thank you very much for giving me this opportunity. And it is nothing but I would try to return whatever I have learned from all of you seniors and this study circle for many years. And it is good. Yes, I also miss the physical hearing, physical meetings. But it is good that we at least have virtual meetings, because this is better than having a faceless meeting. Because now is the time of all faceless. But then at least virtual is better than faceless. So, yeah, let me start off with the topics, and the first one I would touch upon is Section 6, essentially non-resident taxation. We have this definition of liable to tax introduced in Section 229A, and this definition affects at least 3 places in the Act. Section 6(1)A, which defines the residential status, or which creates which has created a fiction last year, that a person who is a citizen of India and who is not liable to tax in any country in the world, he would be deemed to be a resident in India. And of course, later on, we have in Section 6(6) to say that he'll be deemed to be a not ordinary resident. But the fact is that he would be regarded as a resident if he's a citizen of India and not liable to tax. So that is the first provision where this concept of liable to tax is used. Then you have Section 1023FE, which we'll deal with in brief. And then, of course, you have tax treaties under Section 90 and 90A, which uses the term liable to tax. So these are the three major provisions areas where this particular amendment of, where this particular definition of liable to tax is likely to be used, and we all will be affected by that. So, as I said, the first one is 61A, and 61A says that an individual who is a citizen of India is deemed to be a resident if he is not liable to tax in any country, and not liable to tax in any country by reason of domicile residence or any other criteria of similar nature. So what does that what does that actually mean? It actually says that, look, if you are a non-resident in all the countries in the world, you are a stateless person, to say so, and if you are an Indian citizen, then we will still regard you as a resident for tax purposes. So it has added one more criteria of citizenship, of being regarded as a resident for tax purposes, apart from the other criteria of physical presence. Now, so when it says that deemed to be resident if you are not liable to tax in any country. Now, there is an ambiguity on what is the meaning of the term liable to tax. So does it therefore mean that there is no income tax law applicable to that person in any in the other country? Suppose the person is a resident of UAE, or he lives in the UAE, not a resident for tax purposes, but he lives in the UAE, and there is no tax law in the UAE. And therefore, can you say that because there is no tax law, he is not liable to tax? And because he is not liable to tax in UAE, and he is not liable to tax that way in any other country in the world, he would be deemed to be an Indian resident, tax resident, because he is an Indian citizen. So that is one interpretation. The other interpretation is that if there is an income tax law applicable to him, the said law provides an exemption to all or relevant income in the hands of the individual. So under what circumstances, what is the meaning that you give to the term, what is the meaning that you give to the term liable to tax? There's a bit of a background in this, and the background takes you to, basically takes you to the tax treaties, where this phrase liable to tax is being used. And the tax treaties tell us that a person is regarded as a resident of a contracting state if he is liable to tax in that state by virtue of his residence, citizenship, nationality, or any other criteria of similar nature. The questions arose as to a situation like this, UAE or some such countries, where there is no local tax law which makes which results into any taxation, or which results into any taxation. So therefore, a person is not liable to pay tax in any other country, or in the country where he's otherwise locally residing. So the question arose first time, or the first leading decision was that of the AAR in Cyril Pereira's case, where a view was taken that, look, there is no local tax law leviable in the UAE, and therefore, in absence of any tax law leviable, you cannot say that the person is resident in the UAE, and therefore, even though he may be residing in UAE physically throughout the year, he cannot be regarded as a resident, and therefore he cannot avail of India UAE tax treaty. So that was the one of the early decisions on this issue. Several decisions came in, and flip-flop views were taken. Ultimately, the matter was finally decided by the Supreme Court in Azadi Bachao. In Azadi Bachao, Cyril Pereira's decision was cited, and then after elaborate discussion and discussing various decisions, Supreme Court said that, having perused the order of the AAR, we regret we are not persuaded. So what Supreme Court said was that a person will be regarded as liable to tax so long as that state has a right to tax him. There is an inherent right of the state to tax him on his world income, whether that law is there or whether the law is not there. If the state has a right to tax him, then he could be regarded as a resident of a contracting state. So that was what Supreme Court said. So it was not material that it is not relevant that that country does not have any tax law. So having with this background, now you have this section introduced, which says that a person would be liable to tax. A person will be liable to tax if uh, 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 if there is any law in the country under liable to tax means that there is a liability to tax on such person under any law for the time being in force. This is what they have said, under any law for the time being in force. And then it says it includes subsequent imposition of tax, subsequent to the imposition of tax liability, there is an exemption provided. So in other words, if there is law in force, then he is liable to tax whether or not he is paying tax or whether or not he is exempted. So in other words, if there is no law in force in that country, then under this definition, he is not liable to tax in that country. And the consequence would be, since he is not liable to tax in that country, and if that person is citizen of India, then he would be regarded as a resident of India under 6(1)(a). So this is how the decision of the Supreme Court in Azadi Bachao has been partially nullified, and all the other decisions have been partially nullified. Uh, the let me just, for the sake of completeness, say that in the context of India-UAE treaty, this will not have much of a difference. I'll come to that when we deal with the treaty provisions, 90. So here, this is the phrase liable to tax used in 6(1)(a), and this is how it has been sought to be now interpreted. Uh, Insofar as the treaties are concerned, uh, treaties normally say that the words not defined in the treaty will take their meaning from the local law. We have explanation 4 to section 90 and 90A, which says that the terms which are defined in the treaty will take the meaning from the treaty, and the terms which are not defined in the treaty will take their meaning from the act. Now, as a result of that, wherever in the treaty the term resident is defined to mean the way which we discussed, that a person is regarded as a resident of a contracting state if he is liable to tax therein by virtue of his domicile, citizenship, etc., then that phrase liable to tax is not defined in the treaty, and therefore it will take its meaning from the domestic law. And now under the domestic law, since liable to tax means that if there is a law in the country, then then and only then he would be regarded as liable to tax in that country. If there is a law and if he is exempted, then there is no difficulty so far as the residential status is concerned. Now, this definition will therefore affect the tax treaty's interpretation as well, and the wider definition which was given by the Supreme Court in Azadi Bachao may not be applicable. Only a word over here that insofar as India-UAE treaty is concerned, when it comes to determining the status of the person in the UAE, it does not use the word liable to tax. It only gives an objective test of 182 days, etc. And therefore, in order to determine the residential status under the treaty, whether a person is resident of UAE or not, you don't have this phrase liable to tax which is used. However, under UAE treaty, when it comes to determining the residential status of the person in the UAE, it may so happen that when you are testing a person's residential status under the India-UAE treaty, you will say that under section 6(1)(a), that person is resident of India. Under the 182 days test, he is a resident of the UAE. He is a resident of both the contracting state, and therefore one will have to determine the residential status of that person by virtue of applying the tie-breaking test which is there in the treaty. So that would happen in the context of India-UAE treaty. In other treaties, wherever the term liable to be taxed is used, the interpretation will take its meaning from the domestic law, which we just talked about. The another section which deals with this phrase liable to tax, it's section 1023 FE. And apart from other things, this particular section exempts certain income by way of dividend, interest, etc., in the hands of a pension fund. Now, the intention, and there they have said that they have put one of the conditions there, that the foreign pension fund will enjoy this exempt status in India if it is not liable to tax in his home country. So the idea is, if there is a US pension fund and if exempt from income in the US, he would be it would be regarded as not liable to tax in US, and therefore that tax exempt status will continue even in India. That is the intention. But now when this particular new definition comes in, this new definition would tell you that, look, US has a law over there, and if it has a law over there, he would be, the pension fund would be regarded as liable to tax in US, and if it is regarded as liable to tax in US, then the 1023 FE exemption will not be available, because it is liable to tax in the US and therefore not tax exempt. So in order to eschew this particular difficulty, which arises as a result of the amendment of section, they have now clarified by way of inserting another portion in this section to say that the exemption will continue to that foreign pension fund in India if it is not liable to tax in his home country, or now they've added this word, or if liable to tax, exemption from taxation of all its income has been provided under such foreign country. So therefore, therefore this is only in the for the purpose of saving the tax exempt status of foreign pension fund. The another provision under this caption of non-resident individuals could be 89A, and this is a case where take a person who is an individual who was a non-resident earlier. At some point of time, he became a resident of India, but he maintains a fund, maintains an account in a retirement fund abroad. Now, the retirement fund account abroad would earn certain interest income for him. Now, this interest income would be taxed in that country, because by virtue of the source rule, it would also be taxed in India because he is a resident of India now, and therefore there will be double taxation, and ordinarily, therefore, he'll be entitled to foreign tax credit or whatever treaty method of elimination of double taxation is there. However, there are difficulties which are observed, that in two different countries, the person is taxed in two different ways. He may be taxed abroad on the receipt basis as and when he receives the interest. He may be taxed in India on accrual basis, and therefore there may be some difficulty for him for the purpose of claiming foreign tax credit. And therefore now what they have said is they have said that in cases of such persons, we will prescribe rules which will say that, which will give the manner in which the taxability has to happen, and the time when the taxability has to happen, so that the person does not lose out on the double tax benefit. Now, no doubt this is a welcome provision, but I may just say over here that such sort of a situation is not only for this individual who is holding retirement benefit accounts. This sort of a problem will be there in many other cases where the person has income in two different countries and they are taxed in 2 different years in 2 different countries. So therefore, there should be some sort of a general provision with a view to provide the tax elimination or foreign tax credit benefit to such persons. Merely providing for this one category is grossly insufficient, is what I personally feel. Then let's get into the provisions relating to charitable trusts. Now, we know section 224 2A is a 224 defines income. Clause 2A says that all voluntary contributions are to be regarded as income. So this is one deeming fiction in the law. Normally a voluntary contribution is a capital receipt, but then this was introduced long time back to treat all voluntary contributions as income. Then at the same time, what was introduced was 11(1)(d), which says that, look, if there's a corpus donation, so somebody gives a donation with the instruction that this will form part of the, this is towards the corpus of the trust, then we will treat it as exempt under 11(1)(d). So a provision was made in 11(1)(d) to grant an exemption. So this continued for many years. Now they have put a new condition in 11(1)(d), and we are now told that this exemption of corpus donation will be subject to certain conditions. And what are these conditions? The condition is that such contributions are invested in 11(5) modes and that is maintained separately for such corpus. So what is the rationale? Why have they done this? Okay, let me just complete what is the other set of provision. 11(1)(a) and 11(1)(b) is another provision which presently allows the exemption of income to the extent the income is applied or accumulated, as the case may be, of 85%, 15%, whatever. Now a new explanation has been added, explanation 4 to section 11(1), which says that application towards charitable objects from the corpus or from the loan will not be treated as application of income. They've added this new explanation. Then to that explanation, they have added a proviso to say that the amount which is not so treated as an application shall be treated as an application in the previous year in which the amount is invested back in 11(5) modes or the loan is repaid from the income of that year. So what we are told is that you get a corpus donation. That corpus donation is not supposed to be spent for the objects of the trust. And what was happening is that I have a corpus, I take a loan. Of course, I'm told that in Maharashtra, taking loan, you will need charity commissioner's approval. So many cases you don't find loans in charitable trusts, at least in the state of Maharashtra. But nonetheless, it is otherwise possible with the permission or in other states. So I have a corpus, I have a loan. This corpus and loan is utilized for revenue purposes, to say it in short, in our normal accounting parlance. So I debit my P&L account by incurring expenses towards the objects of the trust. As a result of that, what would happen is that there would be a deficit which would come in the profit and loss account, because I don't have corresponding income. What I have spent is from the corpus or from the loan, and therefore income on the credit side of the P&L account is not there. However, there are expenses on the debit side of the P&L account which would give rise to a deficit. This deficit, as per various case laws, was allowed to be set off against future income of the trust. Why? Because this is nothing but excess application of the income which has happened in the past. So that excess, so therefore it's nothing but application of income which has happened in the earlier year. So therefore that deficit was allowed to be carried forward and set off against income. Now in this particular process, apart from this, now when I repay the loan, that repayment of loan is also regarded as the application of income for charitable purposes under case laws. When it comes to acquisition of assets, that acquisition of assets is also regarded as application, or acquisition of asset is also regarded as an application of income for the purposes of objects of the trust, and therefore buying of an asset is also treated as an application for the purpose of 11(1)(a) and 1(b). Now with all this, and apart from all this, you claim depreciation on those assets which are acquired. So depreciation forms part of the debit in the P&L account, and therefore that is also regarded as an application. So to plug that loophole, they brought an amendment 2 years back to say that that either you capitalize the asset and claim depreciation, or you claim claim the entire asset. You may capitalize it, but you may claim the entire asset as application. So if you have claimed the entire asset as application, then depreciation won't be permitted. If you have not claimed the entire asset as application, then depreciation will be allowed. This is what they had done last year in order to avoid, or in order to prevent double deduction in that behalf. However, the double deduction in behalf of corpus and in respect of loans would it does still does continue, and therefore in order to plug that, this amendment is sought to be made. They have also added an explanation 5 to section 11.1, and in explanation 5, they have said that for the purposes of 11.1, it is hereby clarified. First of all, they are saying it is hereby clarified. So we don't know whether it is clarificatory and therefore retrospective. Then there's another difficulty. Calculation of income required to be applied or accumulated shall be made without set off or deduction or allowance of any excess application in the past years. This is what they have said in explanation 5. So in other words, the deficit which was allowed to be carried forward and set off in future is now completely done away with. The entire deficit set off is concept is wiped out. So this is another explanation they have added. So these are the so what they don't like, they have tried to eliminate those things. So they didn't like uh, uh, double deduction, or sort of first taking an exemption for corpus donation, and then also claiming the application from the corpus as an application of income. So they were saying that there is a double benefit. Then so far as loan is concerned, you incur expenses out of the loan, you claim it as application, and you repay the loan, you claim it as application. We don't like the double. Therefore we are trying to make amendment for that. And here we are saying that, look, that deficit you are carrying forward, we don't like that carry forward of deficit. You earn that income, spend that income, deficit carry forward we don't like. So they have made this amendment. Fine. So far as double deductions are concerned, there may be some merit in this particular amendment. So I don't have much major issues there. But what are the issues which are arising now as a result of this drafting? Application out of the corpus in year 1 will probably suffer now a double disallowance instead of double benefit. And how that is happening? First, we are told that when you have a corpus donation, that corpus donation should be deposited in 11.5 modes. Then and only then the corpus donation exemption will be available. So if I don't deposit in 11.5 mode and I spend it for charitable purposes, then that exemption is gone. If the exemption is gone, then there is a under section 224(2)(a) that voluntary contribution becomes my income. So exemption is gone, there is an income which is happening. So there is one effect over there. Second effect is that the amount spent towards the object will not be treated as amount spent towards the object. So I have from the corpus spent something towards the object. That explanation 4 says that it will not be treated as spent towards the object. So that debit to the profit and loss account will not be allowed to me, not treated towards the object. So therefore there is a double jeopardy here, double whammy over here. On one side, what is the corpus donation will be treated as my income, so that becomes income A. And also to that extent, whatever expenses I have incurred will not be treated as an application of income. So although there is an income, there is no application of income, both by virtue of deeming fictions are disallowed. And as a result of that, corpus donation will be treated as income, and the amount spent will be not treated as an application. And therefore, instead of my taking a deficit carry forward, now I will end up paying tax on the corpus donation. So this is one one particular negative impact of this, and I'm sure this needs to be very, very heavily represented at all levels, and this has to be rectified. You can't say that for so many years you took double deduction and therefore now we should pay double disallowance. I don't think that is even the object, and they should not be doing it. Then another issue, redeposit in 11. So now I redeposit that in 11.5 in year 2 to be treated as an application in year 2. But there is no provision to say that in the year 2, 11.1D will be exempt. So I spent it, but then I once again deposit it in the next year or in the subsequent year in 11.5 modes. Then they said that, okay, when you redeposit, we will consider that as an application of income. Fine, that is treated as an application of income. But then that is only a single thing. What happens to that amount which has been already taxed as corpus donation? That corpus donation which has been treated earlier as taxable, now that exemption also you should give. Na? You are not allowing that deficit, and you are taxing that corpus. So that double deduction, not even in the first year, not even in the second year. That is the second implication. Then explanation 5 says that, look, all your past deficits are going to be wiped out. All the past deficits are wiped out. All right. So today I'm carrying forward some past deficit. Now that past deficit from the next year, assessment year 22-23, will not be available. So you have to forget about it. So I will say, okay, fine, you have already treated it as an application of income in the past year. Now we are not treating it as an application of income because that was from the corpus. So fine, fair enough. If I invest that much in 11.5, you will allow me, no? Or if I repay that much loan, you will allow me, no? So fine, that is all right. But no, that doesn't seem to be so. Although the scheme is like that, but what they have said that in the proviso, they have said that the amount not so treated as an application shall be treated as an application at the time when it is redeposited or repaid. So it is only if I have faced a addition in the earlier year in respect of the corpus or in respect of the loan which has been spent but therefore not treated as an application. If that earlier spending is not treated as an application, then the repayment of loan or replenishing 11.5 deposit will be treated as an application. But here is a case of the past years, and in the past years, it has been treated as an application, and therefore there is a deficit, and therefore it is an excess application of earlier years. Now that will not fall within the exemption provided in the proviso, and therefore I think whatever past deficit is there, even if you repay that past loan and even if you replenish that 11.5 corpus towards the corpus, you are not likely to get unless this proviso is amended to that effect. So so this is another implication which I thought from a plain reading of these provisions comes out. Then we are told that investment or deposits in 11.5 mode has to be maintained specifically for such corpus. Is to be maintained specifically for such corpus. Therefore, what does it mean? Does it require creation of an earmarked fund? So there is a corpus and then there is an earmarked fund for that, and then I need to maintain both on the liability side the corpus and on the asset side that earmarked fund. Does it mean that maintained specifically for such corpus? I don't know how it is possible. Take an example that in first year the corpus is deposited in 11.5 mode, but in the next year it is not maintained. In the next year it is not maintained. I have spent that money. Then what happens? Is there a provision to say that it will be that the corpus will be deemed to be the income of the next year? Or does it say that that application will not be treated as an application of income? So that application from the corpus will not be treated as an application in the next year. 11.5, another difficulty. 11.5 includes immovable property. Now I may keep on claiming depreciation on that immovable property. Then if I claim depreciation on that immovable, will you say that no, now you have not maintained that corpus. You have not maintained that, that asset, or you're not maintained in 11.5 mode. Why? Because that asset gets depreciated. I don't think that can be said. But one possible way of dealing with it, that you create a depreciation reserve. So you have a corpus, you have that immovable property on the asset side, both match with each other. And so far as depreciation is concerned, don't reduce the net amount. You just say create a depreciation reserve so that there is no mismatch appearing on the face of the balance sheet. And 11.6 gives you an option either to claim the asset acquisition or to claim a depreciation. Now, another practical difficulty, 11.5 modes does talk about immovable properties, but what about movable assets? So therefore, there is a corpus donation which is given for the purpose of acquiring, say, an MRI equipment to a hospital. Now that equipment is not immovable property. It is not covered under 11.5, and therefore it will not satisfy 11.5 definition. And if it does not satisfy 11.5 definition, then that corpus donation will be taxed. That spending towards the MRI machine will be not treated as an application of fund. So this sort of difficulties will arise, out of this amendment. The other set of amendments in charitable trust section is that of 1023C, where 1023C there are two clauses, 3AD and 3AE, which exempts income received by a person on behalf of educational and medical institutions. If to be exempt if their annual receipt does not exceed 1 crore rupees. Now today this 1 crore rupees is prescribed under a rule. Now we are told that this 1 crore will become 5 crore. This 5 crore is now provided in the section itself. You don't have to go to the rules. But then we are told that this 5 crore will be in aggregate for all the institutions or universities you may be running. A particular trust or a particular person is running, say, various small medical institutions or universities. Then this 5 crore is a combined sort of a limit that you have to see. And this is probably because of the Karnataka High Court decision in Children's Education Society, wherein it was held that the limit on receipts under this subsection is to be considered separately for each institution. So now they have to overcome this particular case law. They have sort of made this particular amendment. With this, let us get into the provisions relating to equalization levy. Equalization levy is a levy on e-commerce operators who are non-residents and who own or operate or manage digital or electronic facility or platform for the purpose of online trading, online sale of goods, or online provision of service. So these non-resident e-commerce operators, they facilitate a lot of trading, but they do not pay any tax in India. Why? Because they are non-residents, they don't have permanent establishment in India, and they don't pay any tax in India. And therefore, there is some income attributable to their income, which should be taxed in India. Because of this global thinking, India, in line with the BEPS initiative, etc., has introduced this equalization levy. Just a moment. The law today is that when the equalization levy applies, the income tax is exempt. So when this equalization levy, first it was introduced for a limited purpose of advertisements, etc. That was 6%. But the last year they introduced equalization levy 2.0, which is really meant for covering this digital platforms, etc. So that levy came into effect for the transactions from 1/4/20, and that is a levy at the rate of 2%. The corresponding income tax exemption they provided in section 1050, and that 1050 was brought into effect for transactions from 1/4/21. So therefore, there was an anomaly in the law that for financial year 2021, equalization levy of 2% would also apply. And if suppose there is an income tax on this, and income tax would of course not apply if that person is a non-resident and does not have a permanent establishment. But it is possible that that payment is in the nature of royalty or technical services. Then in such cases, there could be income tax liability as well. So, so therefore, so during financial year 2021, both these levies were there, and now so that was therefore an anomaly that I pay 2% also and I pay a 10% royalty or FTS tax also. Now they have removed that anomaly and said that no, the equalization levy applies to transaction after 1420, and the income tax exemption will also apply to transactions after 1420. So now there is no anomaly over there. That's one thing that they have done. Second thing is the law provides today that when there is an overlap like this, then for that overlap you have to first see whether whether equalization levy is leviable or not. If equalization levy is leviable, then you enjoy tax exemption. So therefore, people were happy that 2% equalization levy is there. I pay 2% equalization levy, and therefore there will be no royalty tax, no FTS tax on that, and therefore I'll be saving that 10% tax by paying that 2% tax. However, now they have told us that no. If the payment is in the nature of royalty or technical services, you will pay income tax and we will exempt you from equalization levy. But if, however, it is in the nature of some other income which is chargeable to tax in India, then you first pay equalization levy and you don't pay income tax. We will exempt you that way. So this is what they have now told us. And one would have, I thought earlier that this will end many litigations on the question as to whether a particular payment is royalty or not, FTS or not. Especially all your digital payments, software payments, right to use software, whether it is royalty, whether it is not royalty, long years of litigation on issues like that. So one would have thought that once the equalization levy is there, then and there is a clear-cut exemption from the payment of income tax, then therefore all those litigations will go away. But no, as a result of this particular amendment today, this litigation would still continue because if it is royalty, etc., you have to first pay that tax. Then they have made amendment in the definition of online sale of goods and in the definition of consideration. And this is by and large to bring about some sort of a certainty and clarity on this, because online, what is online? Online is where something is done through an internet or through a digital platform. Now, when they say online sale of goods or online provision of service, so if I buy goods through Amazon, the goods don't belong to Amazon. If it belongs to a third party, Amazon only facilitates me to place order, purchase the placing order, acceptance of order, making payments, etc. If I buy a cinema ticket on Book My Show, then Book My Show doesn't show me the cinema. Cinema is shown by the service provider, the cinema house. The Book My Show would only enable me to book my tickets. Okay, so there is no a sale of goods online, except for, say, music is sold, it may be sale of goods online. A software is sold, maybe a sale of goods online. But if I buy a TV set through Amazon, it is not sale of goods online, and therefore one interpretation was that it would never qualify for equalization levy because it is not online sale of goods, it is not online provision of service. In order to plug that loophole, now they said that online sale of goods and services would include acceptance of offer, placing a purchase order, acceptance of purchase order, payment of consideration, and part supply and whole supply, whatever, everything will be covered. So this is one amendment that they made. As a result of this, there will be difficulty in the sense that what is the amount on which the equalization levy will be paid, and that is a very large difficulty which will arise. As of today, suppose you're selling goods through Amazon and Amazon is entitled to only a commission. You're booking tickets through Book My Show and Book My Show is entitled to only commission. It was that commission income on which it would pay that 2% equalization levy. Now we are told that acceptance and placing order and everything is to be considered as goods or service or online provision of goods and service. Then the way the section is worded, the entire cost of goods and the cost of service to which that poor fellow facilitator has got nothing to do. He's interested in only his commission. The entire consideration for the sale and purchase of goods and services will become the base for calculation of equalization levy, and therefore that 2% will probably turn out to be more than his income that he is earning by way of commission or facilitation fees in this equalization levy. So this is going to be a huge issue, which I'm sure everyone is going to represent on this, and we will have to just wait and see what happens on this issue. Then they've defined consideration. Consideration would include consideration for sale of goods, irrespective of whether the e-commerce operator owns the goods or services, and irrespective of whether the services is. So therefore, this is also a reason why that consideration would be the total consideration. So these two definitions read together will give rise to this particular anomaly. Not anomaly, but a difficulty in terms of commercial aspects of a particular transaction. Then for startups, nothing much to discuss except that they have extended the 80 IAC and 50 GB dates from 1/4/21 to 1/4/22 for both these particular provisions. Nothing much to discuss over here. Let's get into the amendments in the housing sector, real estate sector. Real estate sector, 80EA provides for deduction of interest on loan from housing, interest on loan for small housing which is availed. The small housing are the houses of where the stamp duty value is less than 45 lakhs. That interest is treated as tax as deduction under 80EA, and that would today it qualifies for loans for small houses which are for houses which were for which the loan was sanctioned during the period April 19 to March 21. So this March 21 is now extended to March 22. So this is one provision. Then you have 80IBA, which grants you deductions of profits of housing projects. There was a cutoff date that you should have obtained the approvals prior to March 21. Now that has been extended to March 22. So that's a welcome provision. Nothing much to say. Housing industry was completely at halt during the lockdown period, and therefore this is a justifiable sort of an amendment. The third one is the safe harbor rule, the tolerance limit for the difference between the stamp duty value and the actual consideration. We all know in November 2012 they introduced this Atmanirbhar package, where they said that the current applicable tolerance limit of 10% will be enhanced to 20%, and that is how this was. Now this tolerance limit today we have this 10% tolerance limit in 43 CA, in 56(2)(10), and we also have in 50 C. The Atmanirbhar package is now sought to be brought into the statute by way of the amendment, and now they have amended the provisions of 43 CA and 56(2)(10) to bring this 20% tolerance limit. And what have they said? They have said that this will apply to the transfer of residential unit that takes place between November 12, 2020, that is the date of announcement of that package, to June 30th, 2021. So it is this limited window for which this particular enhanced tolerance limit will apply. Then such transfer is by way of first allotment of residential unit to any person. So first allotment will qualify, secondary sales, subsequent sales will not qualify. Then it applies only to consideration received does not exceed 2 crore rupees. So therefore, it applies to small residential units only. It does not apply to larger residential units more than 2 crores. Certainly, this is, I mean, from a point of view of difficulties faced during lockdown, etc. Certainly, this is a welcome provision. There's no doubt about it. Whatever we have got is got. But at the same time, I would feel that government is indeed stingy. That it could have been a little better, drafted provision. What they have done is that 43AC is amended, 50C is not amended. Now, 50C is not amended on possibly on the footing that it's a secondary sale. But it is not necessary that it will always be secondary sale. Take a situation where a landowner has entered into a development agreement. Under 45(5)(a), he is taxed on on the value of the stamp duty value of the area that he is taxed, that he is getting from the landlord, and then thereafter he sells the flat to the new purchaser. Now here nobody gets 50CA. Nobody gets the benefit of the increased tolerance limit of 20%. Neither that landowner gets at the time when he is taxed, nor does the first time buyer gets when he buys, and of course the builder does not get, because builder has not to recognize that as revenue at all. So in this situation nobody gets this benefit of 20%. So had 50C been amended, then there was a possibility of covering these type of people as well. Number one. Number two, one would convert his stock in trade to capital asset, and we have section 28 to say that when stock in trade is converted to capital asset, the stamp duty value will be the basis on which we will pay the tax. Now that is frozen. This safe harbor is not available to such cases also. So it is not something that the 20% is standard deduction, so you reduce that stamp duty value by 20%. No, that is not so. It will not apply to even that provision. It will apply only to these limited provisions. Then they're talking about transfer of residential unit takes place by way of first allotment. So I can envisage a lot of litigation on this question of what you mean by transfer of a residential unit. When does a transfer of a residential unit happen in case of a builder? The transfer in case of a capital asset takes place at different points of time because you apply 247. Transfer in case of a builder happens at a different point of time because 247 does not apply to him. So it says when a transfer of used residential unit takes place between these periods. So what happens in a case where an allotment letter is issued, agreement is not made? An agreement is made, possession is not given. Agreement is made, but it is only an agreement to sell, and practically speaking, you are only going to pay him, milestone payments. The builder is going to recognize his revenue at a later point of time, which will be much later than June 30th, 2021. When is the transfer taking place? So the benchmark of the agreement, is it really there in this particular provision? Not there in this particular provision. Is the benchmark of the agreement date, which is embedded in 43CA, will also find place in this solution, in this particular provision? It should ideally be, but 43CA talks of transfer, 50 talks of receipt. Where do you identify? Where at what point of time do you see? So allotment letter issued before 30th June and agreement entered into later. So there'll be a lot of difficulties. People will have to probably enter into agreements before 30th June, and just mere allotment letter may not suffice, because if you say that first allotment is what is qualifying, then therefore allotment letter is good enough. It may or may not be good enough. I don't think it will be good. Then builder issues allotment letter to A. A cancels the allotment and the flat is then sold to B. Will that qualify? Will that qualify for this enhanced 20% tolerance limit? I have doubts because it talks about first allotment. Or can you say that no, that first allotment was actually cancelled and therefore that was no allotment only, and therefore the first allotment is to be only. And if that first allotment has to be, then that will have to be before 30th of June. So if A is before June, B is after June, nobody is going to get the benefit of that. So this is these are some of the difficulties which I thought. And of course, they have defined residential unit to be an independent residential unit. Uh, there could be some issues on that, but I don't foresee many issues coming out of that definition of residential unit. It is an independent unit which has its separate cooking facilities, sanitary facilities, living facilities, etc. Independent of other residential units. So you should not be walking through one person's residence to go to your residence. So that sort of a definition is there. uh, I don't foresee many issues unless somebody has foreseen some such issues. And one more thing that that it's not only the residential units which require this particular tolerance limit, enhanced tolerance limit. It is also the commercial units. There are small commercial units which are also unsold because of the lockdown and because of the recession in the real estate market, which started much before that. So therefore, why restrict only to residential units? Have even commercial units over there. So these are some of the thoughts. Let's get into the provision dealing with business reorganizations. The first one is slum sale. They have slum sale to slump exchange is what the subject matter of plugging that loophole in the law. We all know decision of of Bombay High Court in Bharat Bijli, where a view was taken that when there is a slum sale, then that slum sale is a transfer of undertaking as a result of sale, and therefore 242C clearly applies. But if there is no sale but there is an exchange, and Supreme Court in Ramakrishna Pillai's case defined what is a slum, what is an exchange and a sale, and therefore consideration is not defined in terms of money, but consideration is defined in kind by way of issue of shares or whatever else. Then it would be regarded as an exchange, and exchange exchange is different from sale, and therefore in cases of slump exchange, it is a transfer of undertaking, no doubt, but it is not a transfer of undertaking as a result of sale, and therefore 242C does not apply. And if 242C does not apply, the taxing mechanism in the act fails, and therefore that tax cannot be levied. This they want to now plug, and they say, and we are now told that a slum sale would include all types of transfers by any means as covered under 247. So 247 transfer definition is brought in over here, and they are saying by any means. So therefore, sale, exchange, relinquishment of rights, etc., etc., everything will be covered. Fine. Now there are two things I'd like to point out. One, a positive, and the other a bit negative. The positive is that the fact that on this issue in the past years, there are a lot of litigation still going on. It's not that everyone has accepted this Bombay High Court decision. So for the past years, wherever these litigations are going on, apart from the merits of those arguments for the past years, one can say that look at the amendment which is made in the law. This amendment is not a retrospective amendment. This amendment is a prospective amendment. And therefore, a subsequent amendment can be regarded as an aid to interpretation, and therefore, in the sense that what was the mischief that was sought to be evaded or avoided by way of this amendment, apply that mischief rule and say that, look, the subsequent amendment itself shows that in the past this provision does not apply, so that litigation becomes slightly easier. So that's the positive side of it. Negative side of it is the transactions that have happened during financial year 2021. There was no real business that has happened in this country for at least 6 months during the lockdown period. But at the same time, there were large M&A deals that have happened for purchase and sale of businesses. And those who have structured their businesses in the form of a slump exchange. Uh, that was for many reasons. It was not for tax planning purposes. That could be for many reasons. That look, the buyer wants to have the cake and eat it too, and therefore, because he does not have money, he does not have enough cash to pay pay by way of consideration for transfer, but at the same time it wants the business to be purchased. And how does it do it? And therefore he issues shares or he issues any other security in consideration of the transfer. And therefore the transaction happens immediately. The buyer does not lose out, the seller does not lose out, and the deal happens. So if that deal was structured as a slump exchange in the past for good commercial reasons, those deals will also probably face the heat of this amendment, because this amendment takes effect from 1/4/21, therefore assessment year 21/22, and therefore the transactions happening in this year would also suffer. Uh, One word on this, and which would be also relevant for the next set, that is depreciation on goodwill, because that also has this effect of affecting early retrospective effect for last 1 year. And that is, yes, the parliament has powers to enact laws retrospectively. Parliament is supreme. There is no promissory estoppel which actually applies to the parliament. That is all fine. So you can say that no, we have powers to make a retrospective tax. Fine. But at the same time, one should also keep in mind the principle that the retrospective amendment should pass the test of reasonableness. This aspect is discussed in one of the decisions of Justice Sujata Manohar in Supreme Court, National Agriculture Cooperative Federation 260 ITR 548. And therefore, one may have to consider this argument. I'm not saying that this is a final thought on the subject, but one may have to consider an argument that, if that a retrospective amendment to something which, like in case of goodwill, something which the Supreme Court had approved in the past. In case of slum sale, it's Bombay High Court which has approved in the past. So in cases where the courts have approved a particular thing, can you say that this amendment retrospective is really reasonable, and therefore it does not pass the test of reasonableness? Is it possible to argue is something which one can still consider? I am aware of the entire Vodafone history and what happened in 2012, etc. Nonetheless, uh, they did not toe this particular line, but one may consider towing this particular line of reasonableness, especially in case of goodwill where Supreme Court decision was there. Now, so depreciation on goodwill, as we all know, Smith Securities Supreme Court held to depreciate goodwill to be a depreciable asset. Intangible assets defined in 211 and 32(1) to mean uh, patent, trademarks, copyrights, or any other business rights of similar nature, etc. And the word goodwill does not find place over there. Matter went up to Supreme Court. Supreme Court said goodwill is a depreciable asset, and it being a depreciable asset, depreciation should be granted on. I would have thought that goodwill is something which comprises of everything. Goodwill may comprise of a locational advantage. Goodwill may comprise of an advantage of the name, the trade name, the trademark, the technology, and whatever. So the individual ingredients which are there in the definition are all also included in goodwill. So how is goodwill different from that individual elements which are there in this section is something which I don't really fathom. But nevertheless, there could be some residual goodwill other than those specified intangibles as well. Fair enough. Now, the proposed amendment, what have they done? They say that goodwill is to be excluded from the definition of block of assets in 31 and 32(1) and 211. So they said that all other business or commercial rights other than goodwill of business or profession. Fine, they've removed it. Now what? Now in the past, somebody has included claimed goodwill, claimed depreciation on it. How? Because it forms part of a block of intangible assets, that 25% block. So it is forming part of the block of assets. Now what they are saying is, we want you to pick up that goodwill element and remove it from the block. So how do you do that? There is no mechanism today of doing it, because in section 43(6) and in section 50, what you can reduce is only sale proceeds. You can't reduce any notional figure. So they said, no, we'll provide rules for that. So they have amended section 50 to say that we will provide rules as to how do you remove the goodwill and park it aside as a separate capital asset, which will now onwards be a non-depreciable asset. Fine. Then they have amended 55(2)(a) to say that, okay, if you subsequently sell the goodwill, so you have removed it from the block, parked it aside, if you subsequently sell the goodwill, that cost of acquisition of that goodwill, you don't go back to the original cost, because 55(2)(a) today says that the original cost or the cost to the previous owner, etc. Now they have said that no, that WDV which is there, which you have parked, which you have removed out, that WDV will be regarded as the cost of acquisition, because you have already taken benefit of the depreciation in the past, and therefore we will not allow you as a benefit by way of part of cost of acquisition. Fine. So I don't think there's any difficulty in that. The similar thing had happened even in the case of stock exchange membership cards, where membership cards were depreciable earlier, that were converted into shares and trading rights, and when those shares were subsequently sold, question arose as to what is the cost of acquisition. Can it really be the original cost? 55(2) really literally reading that the original cost becomes the cost. But then you had Bombay Tribunal taking a view that no, you have to look at the depreciated value. Anyway, now they have amended this section. Fine. There is no ambiguity on it. But 43(6) is not amended. 43(6), which really defines WDV, that has not been amended. So what are the implications? 43(6) not amended, 50 amended. Can you therefore say that under 43(6), which is the base for calculating depreciation, there will be one WDV which will be going on. So for the purpose of claiming of depreciation, I will have a WDV which is under 43(6), which is unamended provision. So therefore that WDV continues. But for the purpose of section 50, I will have another WDV which will be going on. And therefore, as and when there is a sale or transfer of a capital asset which is forming part of the block, and when 50 has to be invoked, I will go by that separate WDV which is going on under 50. Can you say that? Certainly it is an anomalous situation. There has to be an harmonious interpretation, and you cannot really interpret the law the way it is. I believe that the 43(6) will be amended. If it is not amended, there will be anomalous situation and people will try to litigate on all these issues. So that is one aspect. Second is, again, there is a retrospective amendment for, sorry, it's not assessment year, it should be financial year. There is a mistake, typo over here in that first bullet point. I'm sorry about that. Retrospective amendment for financial year 2021. It will affect the so goodwill not permissible to be claimed depreciation in financial year 2021 as well. Then identify the specific intangibles in the agreement. Now that you have to live with this particular amendment, what are the consequences? What can you do about it? The real thing that in fact, some of us always did in the past, and now we'll have to be very cautious of doing it in future, is that when you buy business, in your agreement you specifically say specified intangibles. If you have bought a trademark which is included in that goodwill, value that trademark, give a value to it. If you value brand, technology, patent, franchises, value each of these items in the agreement if it is an itemized sale. If it is not an itemized sale, if it is a slum sale, at least you write in the agreement that my business comprises of several assets being land, building, plant, machinery, etc., and several intangibles being trademark so-and-so, technology for so-and-so production, patent so-and-so, registration number, blah, blah, blah. You identify those assets. You need not quantify, because quantification will take it out from the slum sale. You don't quantify. When you do a purchase price allocation, you quantify, you value each of these and quantify each of these, rather than taking the difference to an omnibus account called goodwill. And once you identify each of these specifically, it is possible that there is some more residue left which you may keep it as goodwill, a residual goodwill, which you can't give any specific name. In which case that small portion will go non-depreciable in future, but all other specified provisions will be, all other specified intangibles will still be eligible for depreciation going forward. For the past transactions where we have not made these specific claims, there one will have to look at the realities of the business, look at the agreements, look at what I have actually acquired in the past, and if what I have actually acquired in the past does comprise of certain technology, certain IPR, certain trademarks, which you are actually using in the business, which has come from there, then I think an effort will have to be made to identify those intangibles. Effort will have to be made to, with evidences before the assessing officer, that look, this is something which was used by him in the past. Now even I am using it now. This patent was registered in his name. Now it is transferred in my name. Although there is no separate consideration paid for it, although in the accounts I have made an omnibus, account head as goodwill. It is not just goodwill. It comprises of certain specific assets. Value it at that point of time and claim depreciation on it. I think you have to succeed on that, because the general principle is that accounting is not decisive of the tax effect. It is the business realities based on evidence which is going to prove, or which is going to the tax effect of that transaction. Okay, so that is what one may have to probably do for the past. Then 55(2)(a) is not very happily worded, but I don't think we need to get into it. We can. That's a technical aspect. The other aspect in this reorganization is these provisions of demergers and amalgamations. These provisions for demergers and amalgamations, which are actually more important from PSU's point of view, and not really from other corporate points of view. I'll just spend 2-3 minutes on this. So far as demerger is concerned, normal companies will get the benefit of tax neutrality in a demerger, provided there is a transfer of an undertaking or a demerger of an undertaking. If it is not an undertaking is defined to mean a business activity taken as a whole. So if it is not a business activity taken as a whole, I merely pick up certain assets and transfer, which does not constitute business, it would not be a demerger. So if I have a huge plot of land which I want to demerge, it may qualify as a demerger under the Companies Act, because Companies Act does not use the term demerger, it only says scheme of arrangement. I can do that hiving off under the scheme of arrangement under the Companies Act, there's no difficulty. However, for tax purposes, it may not qualify as a demerger because it is only an asset but not an undertaking. Now, for the purposes of PSU's demerger, we are told that if a PSU would demerger only an asset, it would still qualify so long as the resultant company is also another PSU. So resultant company is a public sector company on the appointed date, is what is the requirement. So that would qualify. So there is a distinction made between a PSU and a non-PSU for the purpose of demerger, and a large plot of land owned by a large PSU, if it is just hived off under a scheme, then that is good enough to qualify as a tax neutral demerger. That is fine. Can there be a distinction between a corporate entity, normal corporate entity, and a PSU is something for us to brainstorm with the lawyers in going forward. Is this an unjust discrimination? Whether it's a justifiable discrimination is something which is a debatable issue. Then comes the provisions for amalgamation. Amalgamation, we are told that in amalgamation 72A enables you to carry forward the past losses. Now, a PSU to PSU amalgamation, there is a blanket allowance of carry forward of losses which has been granted. However, in case of certain PSUs where there is where the amalgamation is not a PSU to PSU. Now, the situation which they are envisaging is like this: that there is a public sector company today. The government sells the shares of that public sector company to a private sector holder. The private sector person who is already company which is already in that business or experience in that business wants to buy that business, buys the shares of that company. What is envisaged here in this provision is that in that share purchase agreement, there would be there would be a restriction in as much as the restriction would say that, look, after you have bought these shares from the government, you cannot amalgamate with this company with any other company for a particular period of time, say 2 years, 3 years, 5 years, whatever. So there's a restriction on amalgamation for a particular period of time, as a result of which that person is not enabled to merge that company with his own company or any other company immediately, and he has to wait for that restriction period to get over. What this provision says is that if you carry out that amalgamation within a period of 5 years from the end of the previous year in which that restriction ends, then we will allow you that carry forward of losses from there onwards. So that is the enabling provision for this PSUs. But here there are some difficulties, and the difficulties are like this: that Mr. A has bought these shares from the government and he has to run this company as that company because of that restriction for that 3-year lock-in period. I cannot amalgamate with my company. I have to run that company on a standalone basis anyway. So I run that company on a standalone basis, and therefore it continues to incur losses for this another 3 years period during that lock-in period. And that thereafter I am allowed to amalgamate. So thereafter I amalgamate with my company, and then the synergies come in, and that synergies would therefore bring about the profitability in both the companies. So then, because of this restriction and there are losses in this 3-year period, what we are told in this provision is that the losses of the PSU till the time it was a PSU will only be allowed to be carried forward. So the losses allowable only up to the erstwhile PSU became a known PSU. So the stage at which you had transferred the shares, at that stage, what were the carry forward losses? Only those carry forward losses will be eligible to be carried forward in future in amalgamation. So what happens to that intermediate tier losses, Baba? You are putting a restriction on one hand that you can't amalgamate, and now I'm forced to continue with this company on a standalone basis without the synergies of my company, and therefore I continue to incur those losses. And if I continue to incur those losses, you are saying that no, in that amalgamation will be the past losses. That is the implication on a reading of this provision, and I think that is unfair. That needs to be corrected. Secondly, what happens to the losses where the 8-year period has lapsed? Because in that intermediate period, only past losses which were, say, 7 years old, 6 years old, they would lapse in that intermediate period of 3 years. So I will not be eligible to carry forward those losses also. So that's another difficulty. So if that position is not rectified by further amendments at the time of passing the bill, then we'll have to find some way out. And two possibilities could be that you think of a reverse merger. Instead of merging this company into my company, you merge my company into that company. That would probably not even attract 72A, and the problem may get over. That is one possibility. Another possibility could be a demerger. Don't do a merger, do a demerger. You may not be governed by this restriction over here. So one will have to fine-tune these thoughts. These are initial thoughts for everyone to ponder upon, debate, study, and fine-tune them. But then the better way would be, to represent and get these anomalies really resolved, or rather the difficulties resolved. That takes us to the very popular, hotly debated, discussed 45.4 and 45.4a, which frankly speaking, I have not understood. And I may request seniors present here to throw some light on that in the question answer session at the end. And of course, Tarak sir to provide his expert comments on this. What interpretation comes out of 45.4 and 45.4a? 45.4 completely redrafted, and Now it applies to cases of dissolution and reconstitution. What is envisaged is, at a time of retirement or dissolution, a partner receives not only capital asset, but he may receive cash or a stock in trade. So long as the partner was receiving capital asset, 45.4 was good enough to cover that situation. And 45.4 was good enough to tax that partnership firm on the difference between the fair value of that asset and the cost of acquisition of that asset in the hands of the firm. But if the partner was not getting any capital asset, he was getting cash. And how he was getting cash, there was some goodwill created in the books, there was some revaluation reserve created in the books that was distributed to the partners in their capital account, and whatever was that capital account balance, that cash was introduced by the incoming partner and cash was given away to the outgoing partner, and as a result of which 45.4, which otherwise attracts to the firm, does not get attracted because there is no transfer of capital asset. And at the same time, the partner whose real capital account is 100 rupees lands up in getting 1000 rupees because of that revaluation or goodwill, etc. He does not pay tax on that amount as well. So nobody pays tax on that. That seems to be the situation which is sought to be covered. So one is that cash and the other is stock in trade, because 45A once again does not apply to stock in trade situation. So these are two possible situations which they want to plug that. And fine, you don't like Mohanbai, Pamabai, you don't like Malabar fisheries, so you never like any Supreme Court decisions, and therefore you want to plug the loopholes, fair enough. But how has it been drafted, how has it been implemented is a question. So 45.4 says profits or gains arising upon receipt of capital asset by a partner will be chargeable in the hands of the firm on dissolution or reconstruction. Now, profits or gains arising on receipt of capital asset. Profit on gain arises on transfer of a capital asset. How can a profit or gain arise on the receipt of capital asset? So that is first, the difficulty starts from there onwards. Now, if you say, no, I receive an asset and therefore my capital gain is my balance standing to the credit of my capital account minus what I have actually received. So therefore, there is a delta over there. There is a big difference over there. That is the capital gain I'm talking about. Oh, I see. That is the capital gain you're talking about. Then I should give a deduction of the amount standing to the credit of my capital account. Now, 45.4 does not say that that is the amount of deduction. 45.4A says that that is the amount of deduction. So what is that? So therefore, what? Under 45A, you want to tax the firm on the capital gain that it has earned on the transfer of assets which was there earlier in 45.4. Is that the intention? Probably yes. If that is the intention, then why have you made a reference in 45.4 to the receipt of capital assets? So these are the issues which we have been debating in last 3-4 days. Nobody has any confined answer. So let me just pose these issues before all of us, and then maybe in last 5-10 minutes we may brainstorm on these issues and get some good thoughts from the participants also. So first issue is why are two provisions made, 4 and 4A, when under both these provisions the taxable entity is the firm AOP BOI, and the full value of consideration under both the subsections include the fair market value of the assets transferred to the partner on the member. So why are two sections made? If 45.4, as I said, is intended to tax the firm on the difference between the FMV and the cost of acquisition, then what is the significance of the reference to the balance to the credit of the capital account mentioned in that section? Why 4 mentions about the credit to the capital account? Not really clear. Is there an overlap? Is there an overlap between the two provisions, 4 and 4A? Because 4 talks of a capital asset, 4A talks of cash and other assets. Now, how do you interpret other assets? Do you interpret other assets to mean everything other than cash? In which case it will include capital asset. If you interpret other assets as other than capital asset already taxed under 4A, then fine, but then 4A does not talk about that. 4A does not speak about that. So therefore, does it mean that 4 and 4A has an overlap? If you read 48 amendment, you feel that there is an overlap which they want to give a deduction under 48. What does it say? 48 says that the total income attributable to the capital asset, which is a word used in 4, total income attributable to capital asset being transferred that means being transferred to that partner, and that will be the total income attributed to that will be allowed as a deduction. So why you are allowing me as a deduction? Probably because 4 maybe you are taxing me, and 4MA also you are taxing me. You are taxing me at two places, and therefore there is an overlap, and therefore in 48 you want to give me a deduction of the total income attributable to that capital. Now, if that is the intention, why do you make this roundabout? Instead, have two different pockets where you are talking about two different provisions. What's the need of 48 amendment? Anyway, you've done that. But now look at the explanatory memorandum which talks about 48. It says that it is introduced to mitigate double taxation when the asset is transferred subsequently by the firm, by the specified entity. Now, asset is transferred subsequently by the firm. So, at the stage when there is an overlap, I have to stay with that double taxation. Later on, when the firm transfers that asset, you will give me that deduction. So, why do I stay with that overlapping double taxation? So that means it is unfair, and therefore I can only interpret the provision in a fair manner to say that the other assets mentioned in 4A actually refers to other than capital assets. So therefore, cash plus stock in trade plus any other assets like assignment of loan, debtors, etc., everything gets covered under 4A. If that is the intention, that is fine. But if that is the intention, then I have not distributed capital asset. Under 4A, you have not taxed me on the capital asset which has been under. You have taxed me capital asset only under 4. And if I have not distributed the capital asset, then why do you give me a deduction after 5 years when the firm transfers that later on? So these are the questions of harmonizing these provisions, and understanding it has become a nightmare. So therefore, I'm just leaving these issues open. Maybe we may spend 5-10 minutes at the time of question answer session on this issue to get some more input from the August audience. Now, there can be issues of transfer of interest by outgoing partner to an incoming partner without the firm paying or distributing any monies. So, will such a situation get covered? So, the section only says when the partner receives. From whom does it receive? It does not say. It doesn't appear that it applies only to the firm which is giving the capital asset or the cash or the other asset. It is from the point of view of the recipient who has earned this sort of a gain, and I am going to tax the firm. The recipient may receive even from the incoming partner. So even for that, you are going to tax the firm. So that is another issue, not very clear. Then in 4A, you are telling us that you will give me the deduction of the amount standing to the capital account as a cost of acquisition. Fine, fair enough. Will indexation be available to me is a question. If you read 48 and there is no bar against indexation, probably yes, you will get indexation. If you get indexation, then from which date? Because from the date on which I am holding the capital asset. Cost of acquisition will take me back to the date I am holding the capital asset. I became the partner in the firm 30 years back. I am retiring today. So then what? You will give me 30 years indexation, or 2001 onwards you will give me indexation. What will you give me? And then what happens to the capital that I have introduced just 5 years back, just 5 days back? What will happen to that? Will I get indexation? Will I get indexation from the day one, from 2001? Problem, anomalies, only questions. Right now, at least I don't have solution to that. Will it apply to reconstitution dissolution which happened in financial year 2021? Yes, because it applies to assessment year 21-22. So this also will have a retrospective effect to that extent for 1 year. Does change in the profit sharing ratio amount to reconstitution? That is also a question which needs to be answered. Change in the constitution. Now you have this provision in the Income Tax Act 187(2), which talks about change in constitution, that in change in constitution of the firm, the assessment has to happen in a particular manner. And for that, you have this 187(2). And there they say change in constitution. In one clause, a change in constitution where partner changes. The other clause is when the profit sharing ratio changes. So 187.2 considers a situation also when there's a change in the profit sharing ratio. Now, does reconstitution mean change in the profit sharing ratio? All right. If I don't get anything by way of cash at the time of reconstitution, or I don't get any asset at the time of change in profit sharing ratio, there is no difficulty. But then after that profit sharing ratio has changed, I may withdraw money. Will you say that that withdrawal of money is towards that reconstitution and therefore I will tax you over there under 4? No. So therefore the moot question to address is change in profit sharing ratio reconstitution? To my mind, no. Because 187, which talks about change in profit sharing ratio as change in constitution, fortunately says for the purpose of this section. So that interpretation is only for the purpose of 187. It cannot be extended further. So therefore, we have to look at what is the general meaning of reconstitution. General meaning of reconstitution under the 1922 Act, there are decisions to say that change in constitution, change in profit sharing ratio is not reconstitution. Uh, there is a Mysore High Court decision on that. And there is also, I think, an Allahabad High Court decision on that. I don't have the citation ready on this. So that cannot amount to change in constitution. That is, to my mind, that's the correct legal position. But this is an issue which will come up. Then that takes us to another set of provisions.
Yes,
Anji.
We can have a 5 minutes refreshing break.
Very well. Okay.
Yes.
Will that be fine?
Very well. We'll reassemble in 5 minutes. So very good. Okay. Thank you. Right.
Members are requested, whatever questions you have, you can put them in the Q&A tab so that we can take it in the end.
Also, members will take a break for 5 minutes and we'll start on time, right? So they can just get themselves refreshed. Right. Okay.
Welcome, friends. Just one announcement before we start with the session. We request the members to kindly come forward for the position of conveners and co-convener for the Vile Pale Study Circle from April onwards. Thank you. Yogesh bhai, you may continue.
Yeah, sure. Thank you. Okay. Okay, so next set of provisions we are looking at are the TDS provisions, TDS and TCS provisions. Section 194 is the first one, where the TDS on payment of dividend to a resident shareholder is what is the provision of 194, and it exempts dividend paid to certain insurance companies. Now, there's an amendment to say that the exemption from TDS for dividend would be extended also to business trusts as defined in 213A, which include InvITs and REITs. And they have also reserved the powers for exempting other entities as may be notified in the official gazette. The rationale seems to be that the dividend income received by these business trusts from the SPV which is created for those specific purposes as permitted under the SEBI regulations, that dividend is exempt because they are pass-through entities. It is exempt in the hands of the trust, and therefore this exemption from TDS is being given. So that's a welcome provision. Is actually removing the anomaly that with that TDS is deducted, that claiming of credit would be an issue. So that is being sought to be remedied. Now we have this wonderful provision of 194E, where banks may have to appoint tax practitioners to compute total income of some of their senior citizen clients. So what does it say? It first of all overrides all of the provisions of the TDS chapter. It will apply when the banker is the payer of what? Payer of pension and payer of interest. And when the payee is whom? The payee is an Indian resident who is 75 years of age, and his only income is pension and interest from the bank where pension account is maintained and no other account qualifies. And this person, interestingly, will have to furnish certain specified information or declaration to the bank. So he will have to furnish certain forms to the bank and give. If these conditions are satisfied, that gentleman, the senior citizen, is exempted from filing his tax returns, and bank will have to, he's not exempted from TDS. The bank will have to do a TDS, but not at the flat rate applicable to your interest income. They will have to do a TDS on the total income of that gentleman by applying the rates in force. So, this is the provision. Now, therefore, this will apply to a very limited class of people. The senior citizens who are in receipt of any other interest on any other bank account other than bank in which he has kept this pension account, receives interest from any other account, bank account or private interest or whatever, or receives a dividend or any other income from any other source whatsoever, he is disqualified. So we can imagine what small percentage of people will be covered. Now, the responsibility of computation of total income for such people by applying provisions of Chapter 6A, deductions, etc., is shifted on the bank. Whether, first of all, how will the bank do it? Bank will do it by getting those numbers in the declaration filed by that person, or we don't know what sort of further papers he will have to give to support his view, because Chapter 6A deductions are also to be given, so that he has made an investment in PPF, he has made this, made that, etc. He will have to give it to the bank. Now, therefore, if the bank has to do these calculations, will the bank be in a position to recover the cost from the account holder for whatever computation that it is doing? We have an instance last year when the bank used to charge for those digital accounts something. Banks were told not to charge anything. Now, will the banks ever be happy with this? Will the banks be able to charge the account holder for the cost that it is going to incur? Number one. Number two, employer's obligation of TDS on pension will now not be applicable on account of non-obstante clause. So ordinarily, the pension is deposited by the employer if it's a defined benefit plan, if it's a defined contribution plan, that the trust, superannuation trust, may give the donation, give the pension to the deposit in the bank, and bank will. So ordinarily, it is the obligation of the employer or the trust to deduct tax at source on the pension amount. Now that shifts, because notwithstanding anything contained, so therefore 204, the person responsible for paying is also overridden. So the responsibility has shifted to bank. But fine, but how will the employer or that trustee know whether that gentleman has any other income or he does not have any other income, whether it is responsibility of the employer or whether it's a responsibility of the bank? Bank should have the data. How does it know? So for that data, one more declaration will have to be probably filed by that person to the employer or to that superannuation trustee. So instead of one filing one form, there'll be two forms, one to the banker and one to that employer. And number one, then for what benefit you are doing all this? Will this filing of declaration by the senior citizen be as simple as your search today? ITR form 1 will have certain pre-filled columns. Do you have that pre-filled columns in this declaration? This gentleman will have to stand in queue, because we have seen queues in the State Bank of India for people collecting pensions on 1st of every month. So he will have to stand in queues not only for the purpose of collecting pension, but also for the purpose of filing these declarations. And he has to file this declaration. He has to fill himself, which are not pre-filled data in any manner. So is there any benefit? I mean, it will be there in the statute book. I don't think it will be of any use to anybody, except that the bank, those who have bank clients, are going to be harassed in some way or the other in order to determine who are those handful of small citizens, senior citizens, small number of senior citizens to whom this will be applicable, and what sort of precautions they will have to take, and what sort of declarations they will have to take. So this is what this provision is all about. Then that takes us to 194Q, TDS on acquisition of goods, purchase and sale of goods. So last year they introduced TCS on purchase and sale of goods. That is the responsibility of the seller to collect TCS on purchase and sale transaction. So TCS, when he collects, it's the tax of the buyer. Now we are told that there has to be a TDS done on a purchase and sale transaction. So therefore TDS will have to be done by the person responsible for paying, that is the buyer is person responsible for paying to the seller. And therefore this is a tax of the seller. So buyer does a TDS of the seller's tax, seller does a TCS of the buyer tax. This is the scheme. How does it, so but then both will apply, both will not apply? We'll see that. It applies in the case of a transaction of purchase and sale of goods. Who is defined as a buyer? Buyer is a person who has turnover in the preceding financial year of more than 10 crores. So when I have to deduct tax at source, I have to see whether my turnover in the previous financial year is more than 10 crores. And I am not exempted under any of the notification, because government says that we will provide a exemption in certain categories. Then who should be the seller? The section says seller should be only a resident. So that's the only condition in the section. So even if he's even if he is that a resident who is an importer, then for buyer that condition is not there. So anyway, so resident, seller is a resident. Buyer should have purchased goods from the seller during the relevant previous year of 50 lakhs or more. So during the previous year, purchase transaction of more than 50 lakhs. Under above circumstances, TDS has to be done by the buyer at 0.1% on such sum as exceeds 50 lakh of rupees. TDS to be deducted at the time of credit or payment, whichever is earlier. Now they have given exception. What is the exception? TDS is deducted where in a case where TDS is deductible under other provisions of these acts. So the purchase and sale of goods, if there is a TDS under any other provisions of the act, then this TDS is not to be done. Secondly, in a case where TCS is to be done under 206C, then this TDS is not to be done. Now here they have said TCS under 206C other than 1H. So this will cover what? This will not cover the last year's amendment, but this will cover cases of TCS on scrap and those tendu leaves and those forest products, and in certain cases that motor cars. So TCS collectible under 206C other than 1H. So in all those cases, TCS will apply, TDS will not apply. But if there is TCS in not under those other sections, those earlier sections, but TCS under 1H, then TCS will be first and not TDS. So TDS is exempted when TCS is collectible on all other transactions like forest produce, scrap, motor car, etc. Now, what are the issues on this? Seller is defined to be a resident, but presently there is no dispensation given to non-resident buyers. No dispensation to non-resident. I suppose that they will give the dispensation by way of notification. Whether GST is included, any sum, because they're saying TDS to be on any sum for the purchase of goods. So GST will be a part of any sum for the purchase of goods, and therefore it would get covered. Whether trade discount can be deducted. To my mind, answer is no, because trade discount is what is reduced from the bill, and I do not pay it as a consideration. And TDS is a time of credit or payment, which is earlier. I do not credit the supplier by the amount of trade discount, because I credit him only with the net amount. So there is no TDS requirement on that. However, what happens to the cash discount? That suppose subsequently a discount is given for an early payment, then that cash discount, what happens? The TDS is a time of credit or payment, which is earlier. So I have credited his amount with the full amount. So therefore TDS obligation arises at that stage. If suppose a cash discount is given subsequently, that may not be reduced. Fine. Advance paid by the buyer. Now what happens where the buyer pays an advance which is more than 50 lakhs. So take a situation where the buyer pays an advance in year 1. In that particular year, the sale is not more than 50 lakhs. So then therefore he does not do a TDS. The seller and he does not do the TDS. In the next year, when there is actual transaction which has happened, it is at that time when he will have the transaction of 50 lakh sale, and in that year he will credit the supplier. So the question is whether in the next year the TDS provision will apply. To my mind, answer is no. In the next year it will not apply. Why? Because the test of taxing event happens at the time of credit or whichever payment which is earlier. The earlier of the two, that is the payment, has already happened, and at that point of time TDS is not attracted. Now, if at that point of time TDS is not attracted, then at the subsequent point of time TDS cannot get attracted. So therefore this will be a situation in which the seller will have to do a TCS. Now, so that is a difficulty. Purchase return after having passed a credit entry at the time of purchase. So what happens to that? Credit or payment which is earlier, I pass an entry. And therefore TDS is done. Later on the goods are returned. So goods are returned, then what do you do? Whether the TDS return, there is no mechanism to say that I can give a credit in a subsequent bill. Seems difficult to me. The question whether goods will include shares and security is another question that is relevant, because that was also the question. That probably they may give dispensation to transactions over stock exchange, but otherwise it may be regarded as shares and securities. Goods, shares and securities will be regarded as goods, and therefore there will be a TDS on that. Practical difficulties would be whether TDS or whether TCS will have to be determined in every transaction by the purchaser and the seller. And therefore the purchaser and the seller will have to coordinate with each other कि भाई तू TDS करने वाला है कि मेरे को TCS करना है. At the time of invoicing, that fellow will never know. If he does not know, how does he put those controls in his SAP system or in his accounting system? Extremely difficult. And if it's extremely difficult and that coordination does not happen, both the parties will say that I don't want to take risk, Baba. 1.1% maybe काटूंगा, तू भी काट, दोनों काटोगा, we will claim credit ourselves. Fine, that's a practical issue which a businessman may sometimes take. But if you do that, there will be a risk of AIR reconciliation. Because in ARR, both the transaction will appear. Both the transaction will appear. The department will say you have reflected only one transaction. You are not reflecting the other transaction. Therefore, there will be a reconciliation mismatch, and therefore there will be an addition on that account. So these are the practical difficulties which may come. Then we are told that a failure of the seller to provide PAN, the TDS will be under 206 AA, and in that case, the rate will be not 20%, but the rate will be 5%. So instead of 0.1%, 5%. Then there is a compliance requirement of AB and CCA for a non-filers. We'll come to that in a moment on this. So this was purchase and sale of goods. Now you have 196D. Here is for a change. Here is a provision which they have introduced so as to fall in line with the so as to overcome a Supreme Court decision which was against the SSC, and that is probably because that was against FIIs, and FIIs would have bombarded the government to say that okay, this is not a fair decision, and therefore you amend the section, and they would amend the section. What was the provision here? You see, when you deduct tax from a non-resident's income, generally under 190, which is generally under 195. 195 says that you should deduct tax at source at the rates in force. And the rates in force takes you to the rate in a particular section, or it takes you to the rate in the schedule in the Finance Act, or it takes you to the rate in the treaty. So therefore, under 195, when I do a TDS, I am entitled to take the rates of the treaty. And if that rate of the treaty is lower than the rate in the Act, I can give that benefit. There is no difficulty. But when it comes to 196D, when there's a payment to an FII, there the tax deduction has to be at the rate of 20% on that certain type of income mentioned there. So the question, so in a particular case, the tax deduction was made at the treaty rate and not at the rate of 20%, and the matter reached the Supreme Court in Pilcom's case, and Supreme Court said that, look, Baba, 195 talks of rates in force. 196D does not talk about rates in force, and therefore, when you are applying 196D, you cannot go to the treaty, you cannot go to the Finance Act schedule. You have to go by 20%, which is stated over here. Full stop. Maybe the FII will have to is taxable at a lower rate because of the treaty, and therefore he may claim a refund by filing a return of income. That's a different thing. But a tax deductor will have to deduct 20%. So this was a difficulty created by this decision. Now they have amended 196D, and now the FIIs are given the benefit of availing the rates under the DTA on proving the tax residency certificate. And the TDS shall be deducted as a lower of 20% or the rates that are provided in the DTA. Then you have this 206 AB and CCA. So one is, we saw that the banker is made a policeman, or banker is made an income tax officer or a tax practitioner for the senior citizens. Here, a tax deductor and a tax collector is made a policeman for the other party. I mean, yesterday Kishore Bhai said that they saw the benefit of 206 AA, so they want to now extend this 206 AB. I fully agree with what he said. And he was very, very vehemently said that this provision has to be vehemently opposed, and it has to be struck down ultimately. What is this provision? 206 AB says that if you are deducting tax in case of a person who is a non-filer, and who is a non-filer? A non-filer is a person who has not filed his return for 2 years, and then there's an added condition. I'll come to that later. In such cases, I have to deduct tax at twice the rate specified in the Act, or twice the rates in force, or 5%, the higher of the three. So I have to deduct tax at this higher rates for non-filer. So therefore, what do I have to do? This, of course, does not apply in certain cases. Salary is 192A, 194BDB, so and 194N, then banking transaction and lotteries, etc. So all other cases I have to apply this provision. So in order to ensure that, what do I have to do? I have to ask for the 2 years returns which are filed by that person. I should have his returns data, whether he has filed returns for last 2 years or not. Whether it is possible for me to by writing his PAN number, can I see on his portal whether he has filed the return or not? I'm not too sure today. I mean, maybe participants may throw light on it in the question answer session. But in any case, why such data should ever be given by one person to another person in a private deal like this? Why should you give your tax returns data to someone? How do I know whether he has filed his return, he has not filed his return? And for that, if I have to take the copies of the return, why it should be given? Why is the confidentiality to be broken? You are asking tax department to maintain confidentiality under 138, and here you are saying no, you will have to give that data of your return filing. So what? How does one satisfy whether that person is a filer or non-filer? Okay. Now, assuming suppose somebody gives you that 2 years filing, that's fine. But it does not give you, then there is one more condition which is attached, which says that if the TDS or TCS in the case of that person is more than 50,000 rupees in each of the last 2 years, then you do the TDS or the TCS as the case may be. So here there may be different interpretations as to this 50,000 should be qua whom, but as I read it, and that is the only way in which this can become practical is that when the deductor is applying this, he will say whether I have deducted tax of 50,000 or more in the past 2 years from this person or not. If I have, in which case, even though he has not given me his details, return details, I will do the TDS. At this, I will not apply this higher rates. Okay. So in cases of those people, where they have given me the return filing, fine. If they have not given me the return filing and I have deducted tax more than that, in which case he would qualify as a non-filer, and he would qualify as a non-filer, and therefore I will deduct at this higher rates over there. Now, this is a provision which has been brought in. And this applies to TDS as well as TCS. TDS is AB and TCS is CCA. So certainly a provision which is very, very difficult to implement. And look at the rates at which you want, at twice the rates of the rates in force, and twice the rates which are applicable under the Act, which will make life extremely difficult for getting refunds in future, etc., etc. It will. You want me to sacrifice my confidentiality, give my data to somebody else? I don't think that's a provision which can ever be upheld by any court of law. So so this is that provision. Now come to salary earners. LTC exemption, a provision which so in place of LTC, they brought this press release last year to say that because of COVID, people are not able to travel, and therefore, if you spend money and spend money in certain manner, and your employer actually reimburses you, then you will get that allowance in lieu of LTC. So, in a way, a welcome provision, but there are certain issues which arise on this. Whether a person who has already availed LTC exemption for one visit in 2018-21 block, will he be entitled to this benefit? Because the rules allow the LTC exemption in two visits in a block of 4 years. So apparently the benefit of this allowance in lieu of LTC. But then the next problem is if a person has not availed any LTC benefit during that period, will he be eligible for twice the amount of the benefit? So somebody has not availed. Then will he be eligible for twice? No, he will be eligible only once. So a person who has already visited in the past, the person who has already availed in the past, he may be eligible for this allowance, I'm sorry, I made a mistake earlier. A person who has already availed LTC in the past, he may be eligible for this allowance, but a person who has not availed this allowance in the past, he will be eligible only for one allowance. That is how I am reading this provision. That's anomalous. Then consider a situation where, because we are told that for the same expenditure, two people will not get this benefit. So a husband and wife situation is there, both cannot claim this benefit. So consider a case of a family comprising of a working couple, and if they have spent say 4,20,000 on one TV set, here those large TV sets, etc., of 5-6 lakh rupees, right? So one of them is eligible for benefit up to 72,000, because what we are told is you will get 36,000 per person. So there are two people in the family, so you'll get 72,000 rupees deduction, or one third, whichever is lower. One third is 1,40,000. So 4,20,000 ka one third is 1,40,000. You won't get 1,40,000. You will get only 72. But one person gets 72. The question is whether the other person will get 68 or not. The difference. Or even though he may be entitled, he will not get, because there is only one bill available for this 4,20,000. For one TV set, you can't have two bills. But if you have different white goods, one bought in the name of the husband, one bought in the name of the wife, then probably you may both may be able to get. But in a situation like this, you will not be able to get this. So that is right. Now coming to other provisions which will affect the salaried earners, 10.11 and 10.12. Okay. So it talks about interest on interest on provident funds. Last year they brought about amendment in section 17(2)(7)(a), where they said that when there is an employer's contribution to three things, to PF, to NPS, and to approved superannuation fund, then employer's contribution, totality of these three, more than 7.5 lakhs, we will treat it as taxable. The employer's contribution will be taxable if the aggregate of these three is above 7.5 lakhs. And they said that interest attributable to that excess will be also charged to tax as a purpose. There are problems over there in that, how do you calculate, what do you attribute? We are not going into that. But now this year what they are saying, that employees' contribution to the provident fund, to the extent it relates to an amount exceeding to the extent of amount exceeding 2.5 lakhs of contribution in any 1 year, then interest attributable to excess of 2.5 lakhs will not be exempted. We will treat it as taxable. So this is what they want to bring about. This particular provision applies to PF. It also applies to PPF. It applies to all funds. And fortunately, of course, they don't. They are saying that limit of there is no aggregation of contribution of all the funds. They are saying to that fund. So you'll have to see fund wise 2.5 lakhs. So PPF for all practical purposes, although it is theoretically there, practically it won't be there because it has an inherent limit of 1,50,000 in a year. So that problem does not lie. And of course, this will apply only to future contributions. It will not apply to past contributions. It will apply to contributions made on or after 1st April 2021. In a particular year, employees' contribution of more than 2.5 lakhs, then the interest on that excess in any of the future years will be treated as taxable and not exempt under 10.11 and 10.12. Now there are some issues arising here. The proviso there refers to interest accrued, and therefore what happens to a person who follows cash method of accounting. Now we have section 7, which deems the interest credited to the account of the PPF holder as deemed accrual and charging it to tax, that, or it's actually treated as deemed receipt under section 7, and income deemed to be received is charged under section 5, and therefore that is taxed. But that provision will not apply here, because that provision applies only in a case where there is an excess of interest given as compared to what is permitted under schedule 4. So more than 12% interest or more than 12% contribution becomes my income under section 7, and it will be taxed there. it will not apply here because we are not talking about that excess. Here we are talking about excess with reference to this 2,50,000, which is not there in part of Schedule 6, Schedule 4. So what happens to a person who follows cash method of accounting? In which year will this interest be taxed? And how do you compute that? When do you compute that? Because the section says that interest accrued on the on the balance which has been on the past contribution more than so in which year you will treat it as income? Can you treat it as income in the year of accrual as the section is worded, or you will treat it as income only in the year when you receive? So does it mean that this section overrides section 145, and therefore irrespective of the method of accounting you will tax me on accrued basis qua this interest? I don't think it can override 145. It will have, if at all this has to be taxed, it can be taxed only in the year in which it is received. But then that will add to all the complications of computation, etc. Then 2,50,000 aggregate. Yeah, no, it will not be aggregate. You will have to see fund wise. That's not a problem. PPF by itself will not have a problem. PF will have a problem. So PF, you are casting an obligation on the trust to deduct this TDS on that interest element. That interest element will then be an interest element under 194A and will have to be TDS will have to be done by the Provident Fund trustee in all probability. And therefore there will be a TDS to be done, although there is no separate section on this particular issue. And of course, we will have to await for the rules that will come. The point here that I also wanted to make was that this is interest on employees' own contribution, and therefore it is not salary. Interest on employer's contribution is regarded as salary, and if that is salary, the TDS obligation falls under the employer. But here it is not salary, and therefore the TDS obligation doesn't fall on the employer. Next one is this ULIP type of insurance policies. Insurance policies under ULIP. Today, 1010D exempts any sum received under a life insurance policy. Now we are told that ULIP, there is a cap of 2,50,000 premium or 10% of capital sum assured. That 10% is already there, and 2,50,000 is an additional cap that is there now over here so far as ULIP is concerned. So the idea is that ULIP will be considered as an investment, and therefore as and when you get money out of this, it will be regarded as capital gain in your hand, and therefore there are backup provisions made to say that these policies will be regarded as capital asset under 214, and a capital gain section is introduced in 45(1)(b) to charge this excess as capital gains in that particular year of receipt of money. However, we are told that the debt benefit would continue, exemption under 1010D would continue in case of a death of an assessee. In that case, it will not be regarded as a capital asset chargeable to capital gains. Then that takes us to International Financial Services Center, IFSC. There's this provision 4D, which 10.4D, which exempts AIF category 3. Now in AIF category 3, where all the unit holders are non-residents, now they want to add another category of AIF 3, which is an investment division of an offshore banking unit. So the idea of all these provisions, I don't think we should spend more time on it. Idea of all these provisions is to invite the foreign entities into IFSC, and therefore these sort of provisions are being made to make the IFSC GIFT City a success. So they want to extend this exemption to the offshore banking unit of IFSC. There are some drafting issues on this. I don't think we should spend much time on that. There is this clause 4E. There is this clause 4F. Here there is a drafting mistake, and this is something which can affect industry also, Indian industry also. We can just have a look at it quickly. So 4F is a clause where there's a foreign aircraft there is foreign aircraft leasing company. That foreign aircraft leasing company is being invited to have a leasing unit in IFSC because that's a financial center and leasing is a finance business. So government is saying this foreign aircraft leasing company, you please come and set up your leasing shops in IFSC. Then from there you lease the aircrafts to the Indian aircraft operators, airline companies. And in which case, when you get royalty, we will not charge you to tax on that royalty. And they have made a provision in 80LA to say that after having leased that aircraft, you sell it to the airline company, either the aircraft or the aircraft engine. Then if there is any gain, we will not tax you on that gain as well. So these are the provisions. So here there should be an exemption in respect of royalty on account of lease of an aircraft paid to the IFSC, to the unit in the IFSC. That should be the provision. However, they've said that royalty on account of lease of an aircraft paid by a unit of IFSC. I think by a unit does not make any sense over here. There is a drafting error which needs to be modified. Then you have this relocation of funds, foreign funds into India, where again they want to invite, and I think this particular provision they will have to give a further sort of a sweetener. I'll just quickly run through this. What it says is that there is a foreign offshore fund which I have called original fund in this diagram. All the unit holders are non-residents. That non-resident fund is a resident of some country which has a tax treaty with India, and that fund is subject to investor protection guidelines in their home country, and then there'll be some other conditions which will be prescribed. Now then they want these funds to relocate into India. Now these funds are essentially India-centric funds. So in other words, this original fund has its investment in Indian companies, and therefore what they want is that this original fund should now migrate to India, and that Indian fund, now they are calling it in this section as resultant fund. So in the course of migration, two things will happen. One is that there will be transfer of those assets from the original fund to the resultant fund. So what are those assets? Those are the shares of the Indian company. So when this transfer happens, ordinarily there will be a taxable gain in the hands of the original fund. We are saying that if you, in the course of migrating here, if you transfer, we will not charge you any tax, fine, prior to March 23. Now, having migrated, this Indian funds will have to issue units to the non-resident investors, right? So this Indian fund, when it issues units to the non-resident fund holders, unit holders, what happens is that their original units will get extinguished, and in exchange of that, they will get the units of the Indian fund. So that is, units of the Indian funds are located in India, and therefore they are received in India, and therefore that will be a capital gain chargeable in the hands of the unit holders. So they are told that no, we will not even charge capital gains when you receive this units of the Indian fund. So in other words, they are making this migration tax free. Now, having made this migration tax free, a question will arise, okay, all right, but what are the benefits that you are going to give me? After having migrated, what are the benefits that you are going to give me? If I don't migrate, I don't have to pay this tax. So this exemption you are giving me for migration, fine. But after that, what are they you giving me? So the answer to that today is that yes, once that original fund may say Indian company shares have come to the resultant fund, when the resultant fund sells the shares of that Indian company later on, that gain would enjoy exemption, provided the original fund was exempted from capital gains tax in India. If original fund was not exempted from capital gains tax in India, had it continued to hold that investment, we are not going to exempt you. So they are targeting Mauritius type of funds where the shares of the Indian company were acquired prior to 2017, which are grandfathered by the India-Mauritius Treaty. Then if you had not migrated and sold the shares of the Indian company, you would have enjoyed that exemption. Now what they are saying is post-migration, you will continue to enjoy the exemption. But that is not good enough. Why should I migrate if you don't give me any other sweetener or any other exemptions in respect of my dealings in India? So therefore, I think I don't think that the purpose of their attracting will get will really get fructified unless they actually give some more sweeteners by way of further exemptions. That takes us to the provisions relating to 36 36(1)(5)(a). So employees' contribution to Provident Fund. 224(10) says that employees' contribution to Provident. So when an employer deducts the employee's contribution, 224(10) says that it becomes employer income. Then employee will get deduction only when it pays to that fund within the due date, which is under 36(1)(5). Now, courts have interpreted this due date as not just the due date under the relevant PF rules, but they have extended it to 43B, and they have read both these sections together to say that due date under 43B is applicable. So long as the employer makes payment before the due date of filing your tax return, this allowance can be permitted under 43B. There are contrary decisions to that, but this was view taken by certain judicial authorities. So now they are amending the act to say that for the removal of doubts, that 43B shall not apply and shall be deemed never to have been applied on this particular transaction, and therefore you don't have to look at the due date in this case. So, so therefore the question is that will this have a retrospective effect or a retroactive effect? There are contrary decisions to that in the past. They have inserted this explanation for the removal of doubts and shall not apply and shall be deemed never to have applied, and therefore this particular provision seems to have a retrospective effect for the disallowance. That takes us to another important aspect of, really speaking, 148 is the most important one over here. Here we are talking of limiting the due dates. 143(1). Now, if we consider assessment year 2021 as the base, your 143(1) should have been issued before 31st of March 22 under the current law. That is 1 year from the end of the financial year in which return is furnished. Now that 31st March 22 will now become 31st December 21. So 9 months from the end of the financial year in which the return is furnished. So they have preponed that. When it comes to issuance of 143(2) notice, so for assessment year 2021, the deadline was September 21. Now the deadline will be June 21. They have preponed by a period of 3 months. Completion of assessment, it was December 22. Now from 21 months, they have made it 9 months. So 12 months is reduced, and therefore the date of completion will be 31st December 2021. So I issued a 143 notice in June 21. My 143.3 should get completed in December 21. So the officers only have 6 months window to complete your assessment in faceless regime. Now the reassessment procedure. 148 completely overhauled. And 153A, 153C, abated assessment, non-abated assessment, everything done away with. Everything now falls under 148. And there are 2 separate procedures for normal cases and for search cases. What are we told? What is the law today? That 148 notice is issued. I file a return. I ask for reasons. He gives me reasons. I file preliminary objections. He has to pass an order of preliminary objections. and then he can call for, make an inquiry and make an assessment and pass an assessment order. This is the present procedure. And this procedure is not necessarily procedure under the Act, but this procedure is a judge-made procedure under the mainly under the decision of the Supreme Court in GK and Drive Shaft, and thereafter many other decisions on this issue. So this is the present procedure. By and large, what they have done is incorporated this procedure in the Act, and let us see what they have done and what are the consequences of that. First of all, AO should possess certain information. That's a precondition, necessity under the Act now. So far, it was a necessity because of Kelvinator's decision, which said that in absence of tangible material, that you cannot do an addition. Now it is part of the Act. AO to possess what information? That is also specified, a flagged information pursuant to a risk management strategy of the CBDT, which suggests that income has escaped assessment. So it is not just any and every information, but this is something which will come from the investigation wing or investigation department or the machinery which talks about risk management strategy. It comes from there. So that is that information which we are talking about. And the second is objections raised by C&AG that assessment is not in accordance with the Act. So these are the two basic information which the assessing officer, one of the two, he must have. If he does not have one of these two, then he cannot do a reassessment under the new law, except in such cases. Then, based on the above information, the AO is required to conduct an inquiry, and before conducting an inquiry, he has to take a prior approval of Principal Commissioner or Principal Chief Commissioner. Now, unfortunately here, there is some difficulty in drafting which needs to be ironed out. They are saying that AO to conduct inquiry if required. Now, AO to conduct inquiry if required shows that it is not necessary for him to conduct an inquiry, and it is not necessary, fine. If it is not necessary pursuant to the provisions of this section, namely that in such cases he is not supposed to carry out, is not required to carry out that inquiry, then it is fine. But if it is left to his whims and fancies or his discretion, then this is not a correct provision. The way it is worded today, it is to my mind not restricted only to search cases. The assessing officer may conduct an inquiry if required, is applicable to both the cases, the search cases and the normal cases, the way I read the section. And to that extent, there's a difficulty in implementing and a scope of litigation. So this is an issue, park it for the time being. Let's see further. So once the assessing officer has conducted the inquiry, now he has got two things. One is that flagged information or the CAG opinion or CAG objection, that is one. Second, since he has conducted inquiry, there are some results of the inquiry. So these two things he has. Now we are told based on these two things, he should issue a show cause to the SSC. That now tell me, why should 148 not be done on you? So he issues a show cause. At the time of issuance of show cause, it is very clearly stated that the results of his inquiry has to be given to the SSC. So he gives the results of his inquiry. It is not very clearly coming out from the section whether the information which was in his possession he should give to the SSC or not. Natural justice would say to my mind that even that information, namely that flagged information and the objections raised by C&AG should be made available. But they have not happily worded it, probably to keep an ambiguity in this, because they may not want to give the entire information to the SSC. But which in this case, according to me, natural justice should require that he is given the entire information so that he can give a proper response. But anyway, one can read it in the manner that he has to give that information also, and he has to give the results of his inquiry. Once that is given to the SSC, SSC has to provide his response to the show cause notice. Once he provides his response to the show cause notice, the assessing officer has to pass an order. He has to pass an order and decide whether this is a fit case for 148 or not, with a prior approval of the Chief Commissioner or Commissioner, Principal Commissioner, Principal Chief Commissioner. So there's a second stage where he goes, or rather the third stage where he goes for the prior approval. First, to conduct inquiry. Second, to give a show cause notice. And third, to pass an order. So all these three stages, he has to take prior approval of the PCIT or PCCIT. Once he passes an order that yes, this is a fit case for 148, then he has to issue a notice to the SSC to file a return of income. Now this notice has a time limit. This notice has a time limit. Now the time limit is 3 years. This time limit is independent of whether earlier 143.3 was done or 143.1 was done. It is independent of that. 3 years is a time limit. There is an extended time limit of 10 years, but that extended time limit, the way it is worded, it reads like this. If the AO is in the possession of books of accounts or document or some evidence that income chargeable to tax represented in the form of an asset is likely to exceed 50 lakhs rupees or more. So because of these words represented in the form of an asset, so first of all, he should have an evidence in form of books, documents, etc. So whatever he has gathered in the course of his inquiry and his information, he has that evidence, which suggests that more than 50 lakhs has escaped assessment. But this is not more than 50 lakhs in all cases. It is more than 50 lakhs in case where the income chargeable to tax represented in form of an asset is likely to exceed 50,000 rupees or more has escaped assessment. So it is only in those limited cases where income represented in the form of an asset, that is the evidence that he is looking out for. Now, now this is a provision. We'll come to a couple of issues on this after this. For search and survey cases, AO shall be deemed to have the information if he wants to reopen within the 3-year period. So deemed to have, so search as well as survey, he is deemed to have information. So therefore he does not need CAG's objection. He does not need that flag information. He is deemed to have that information. So that so that those two things are not required. In search cases, he is not required to conduct an inquiry, and he is not required to issue a show cause notice, and he is not required to pass a speaking order that this is a fit case for 148. He can straight away issue 148 notice in a search cases. Because why? Because he has that information already available, which shows that income has escaped assessment, which he has found in the course of search. Then you find in the new provisions the concept of reason to believe has gone away in 147. The 147 said when a assessing officer has reason to believe. Is there any implication of that or not? I don't think so. There is an implication. We'll just discuss it briefly when it comes to the issues in the next slide. Now, if inquiry is conducted and order is passed pursuant to 148 notice, that is in respect of, say, income A. And during the reassessment proceedings, he comes across income B. Then the provision now says that he is not required to follow the procedure of making inquiry, issuing show cause notice, passing an order, etc. That procedure is not required now in case of income B, so long as he has done that procedure for income A. The question arises over here as to whether this particular provision does away with or overrides the ratio laid down by the Bombay High Court in Jet Airways and all other subsequent decisions. To my mind, the answer is no, because the language of this section and the language of the current section is almost the same. Jet Airways and the subsequent decision has taken into account the old language that the assessing officer can take into account the other, income also. They've taken that into account and passed those orders. To my mind, the ratio of Jet Airways still holds good, and therefore what? What is the consequence? That if your initial inquiry was qua income A, in the course of reassessment proceedings, you also come across income B. But when you make a final assessment order, you say that, okay, A is something which has not escaped assessment, but B is. In which case you cannot make assessment of B under the old law. That position even continues now. Or suppose assessing officer makes assessment of both A and B both, but commissioner removes A. then B cannot survive on its own legs. It has no legs to stand. His legs, B ka legs to stand is the inquiry which is conducted, which is a valid inquiry for A. So without any legs to stand, B cannot sustain. So therefore we have those decisions to say that if A has been removed from the total income by the commissioner or the tribunal, B cannot survive. That ratio to my mind remains the same. That position does not change under the new law. Now, what are the issues, other issues apart from this jet airways? Borrowed satisfaction theory. You find that now it is incorporated in the law. We had those decisions to say that reopening cannot be done merely on the basis of an audit inquiry, or it cannot be done merely on the basis of investigation officer's report. The assessing officer has to independently apply his mind, and therefore 148 cannot be done based on borrowed satisfaction. It should be his own satisfaction. That theory now finds place in the statute itself. Second, take a situation where inquiries were conducted during a 143.3 proceeding, and now he does 148 for the very same item where he had asked me questions. So as of today, we are arguing that boss, in one there's a change of opinion. You cannot do a 148 in case of a change of opinion. Does this concept still remain, or is it by any way overridden because you have those informations with you, etc.? I don't think that that concept is overridden. That still continues as it is. There, it was based on reason to believe, and reason to believe is different from reason to opine, or is of the opinion, and that was the basis, one of the bases on which those decisions were, rendered. That words are not there, but still, I think that concept of change of opinion continues. Why? The reason is that 147 applies if income has escaped assessment. Now, what is the meaning of escaped assessment? You had asked me a question, I had answered you, and you choose not to make any addition in 143.3. Where is the income escaping assessment? What is the meaning of the word assessment? Does the word assessment mean the final assessment order? Or does the assessment mean the entire process of making an assessment? Courts have said that assessment means the process of making an assessment. Now, where is the process of making an assessment escaped? It has not escaped. You asked the question, I have answered you. There is no escapement, and therefore, now if you are asking me the same thing, it's a change of opinion on which 143.3 cannot be done. So therefore, that theory again applies to my mind even in the current law as I read it. Take a second situation where C and AG, now they have we are told that there is an objection by C and AG, and therefore that objection is also an information. It says object. What is the objection? That the assessment is not made in accordance with the provisions of the Act. So therefore, that is effectively an opinion of C and AG, that assessment is not in accordance with the provisions of the Act. So does that by itself override this change of opinion theory? No, I still think that there is no escapement. The escape, if you feel that the order is erroneous, not in accordance with the Act, you have section 263 as a recourse because it's erroneous, completely wrong. Then erroneous, you can invoke 263, that mechanism. But here you can't say it as escaped assessment because assessment is the process of making assessment and not just the order. Inquiry is not conducted. So another situation, inquiry is not conducted under 143.3, but adequate disclosure are made. In the earlier law, you had an extended time limit from 4 years to 6 years in those cases where there was a non-disclosure. Now here, does it apply? I don't think so. Even that here also, even in such cases, 3 years time limit will apply. However, 10 years time limit will apply only in those cases where income chargeable to tax is escaped assessment, which is represented in the form of asset. So whether 10-year will apply or 10-year will not apply will depend upon the interpretation of what do you mean by income escaping assessment, which is represented in the form of asset. So take a case of an unsecured loan credited in the books, whether the 10-year limit applies or not. So can you say that there is a loan which is credited in the books in the past year, 7 years back? that loan is represented in the book, and it is there in the books, and therefore it is represented by some of the other assets which are there in the books of account. And therefore it is income which is represented in the form of an asset, and therefore 10 years extended limit will apply to you. That is one sort of a situation. Other sort of a situation is it's not recorded in the books. There is some on money which has been the papers have come into light, and therefore that information is received, and therefore that for that income, can you say that the 10-year time limit applies? Now, unless and until that is represented by some asset today, that 10-year time limit cannot apply. That on money has come and gone. It has been used. Probably there is a telescoping which has been done. Can you apply that? Does the telescoping theory go away? I don't think it does, even in the current law. So, but then unexplained cash credit which is there in the books, can probably the officer can say that this is represented by some of the other assets in your books of account even today, and therefore it is an asset which is represented in the form of an asset, and therefore 10-year time limit applies. There is a debate on this still, not a final view on this, that you can't widely construe this term represented by an asset. You have to construe it only with reference to your provisions of section 69, 69A, etc. And there it does not, that is an unexplained cash credit. Here you are talking of represented by an asset, and therefore there should be some asset which is in the form of an evidence that you are looking at. So there's a debate on that. I would personally feel that if it is represented by some asset on the asset side, it would still be entitled to the 10-year time limit. That's a possible danger, but certainly something which needs further deliberation and fine tuning on this issue. New tangible material theory continues, especially where adequate disclosures are made. Now, new tangible material theory is embedded in the law itself, because that tangible material is that information which is there, based on which, because without that 148 cannot be done. In such cases, incriminating material theory, whether it continues or not, answer is yes. Why? Because the scheme of the act is such that in such cases they are doing away with the requirement of conducting further inquiry, passing an order. In such cases, they say that we don't want that flag information to be there or CAG's opinion to be there. We don't want all those things. Why? Because search itself is a material which shows that income has escaped assessment, and therefore it is on the basis of that material that he will do the assessment. Now, if in that material there is no incriminating material, can the officer say that, all right, in search I did not find anything, but I don't like your ATIA claim that you made 7 years back, and therefore I will do a reassessment proceedings of that 7 years? Is it possible? To my mind, no. Because the scheme of the new provisions is such that in such cases, why do you dispense with the procedural requirement which is otherwise there for 148? I am dispensing it only because the search itself has the material and therefore it is on that basis you are doing assessment. You can't do assessment on the basis of any other material other than search material, which is because there is no requirement of flagged information. So this is what the point is, that incriminating material theory, to my mind, still continues in such cases.
Yes, sir.
Yes, sir.
Can we take question answer next 5 minutes?
All right, we'll do that. All right, we'll do that. I'll just quickly then try to compliances 44 AB, AD, 139, 155 time limits. They're all tabulated, nothing much to discuss. 139, okay, advanced tax on dividend, provisional, fake invoice. All right. Dispute resolution committee, can I just spend 2-3 minutes on that? This provision is is intended to apply to small SSEs, where I'm told that where the returned income is less than 50 lakhs, and the variation is less than 10 lakh rupees. It is not a search case, not a survey case, not a case under exchange of information under DTA. It should not be a case of any tainted criminal law like Coffeposa, etc. It will apply only to those limited cases. And but the point is that what is this whole provision about? This provision today is only retaining powers with the civility to do what? They are retaining powers, number one, to constitute a DRC, Distribution Committee. They are retaining powers to specify the persons or the class of persons in whose case the dispute may be resolved if the person opts for it. They are retaining the powers to lay down what types of orders will be covered under this. They are retaining the powers to frame rules as to whether the DRC and to what extent the DRC can reduce or waive the penalty or grant an immunity from prosecution. They are retaining powers to have a faceless DRC and so on and so forth. So the provisions are only enabling provisions for retaining these powers. There is no guidelines whatsoever, like the present DRP. There is no guidelines in the act whatsoever at what stage the DRC has to come in, whether at draft stage or at final stage, whether it is in lieu of appeal or it is in addition to appeal or it is parallel to appeal. Nothing is known. Whether the DRC orders would be itself be appealable or not appealable, we don't know. Whether they'll be binding or they'll be not binding, we don't know. Whether binding on only the SSC, only the department, or both, nothing is said, no guidelines given. Who should constitute DRC? whether people from the department or from the judiciary or from the industry or whatever, nothing is said. How many members should be there? Nothing is said. So there is no guidance given over here. So therefore, to my mind, this provisions uh, suffers from an excessive delegation of authority. An excessive delegated legislation is there, and to my mind, I think there should be some guidelines given, like the present DRP, so that the rules which are framed is in conformity with what the Parliament wants. Otherwise, the rules which are framed will be at the whims and fancies of the bureaucracy, which I don't think will ever pass the test of constitutional validity on this. And Board of Advanced Ruling, not really very important. We can skip that for the time. Settlement Commission dispensed with. Faceless ITAT, just a word on this. I don't know how the faceless ITAT will ever work. Faceless ITAT, how today faceless assessment is working by my giving written submissions and giving documents on emails, etc. Faceless Commissioner Appeals is also doing the same thing. Faceless Commissioner Appeals orders, I haven't seen in this last 1 or 2 months. Lot of notices have come. We have made submissions, but I haven't seen orders how it is happening. But faceless ITAT, how will it work? Just consider in the ITAT today, if I'm asked to give written submissions, there is an appellant, there is a respondent, either SSE or the department, whichever way, depending on whose appeal it is. First, the appellant argues, then the respondent gives his rejoinder, and the final word is once again with the appellant. He gives his reply to the rejoinder. So this is the way the argument happens in the tribunal. Now we want all this by way of written submissions. So the first written submissions are given by the appellant. The respondent will give his reply, his rejoinder to the written submission, and then I will give my reply to that. So each hearing will take 1 or 2 months, because it is not easy for you to sit and draft written submissions and give page references of 1,000-page paper book in those written submissions and make it precise and give it in a matter of 1 hour or 2 hours. People will need time for these these are the 3 events which will happen one after the other. How will it happen? Every appeal will take 2 months toward disposal. So I don't see how this particular provision can ever see light of the day. And I'm sure that there'll be many writ petitions which are going to be filed on this particular. Somebody was joking yesterday that what do you mean by faceless tribunal? That there is somebody sitting over there whom I cannot see, like Mugambo sitting over there, and I cannot see who is sitting there. There's a blackout. So I don't know who is he, and both the people will argue, and then Mugambo will decide कि मैं खुश हुआ कि मैं नहीं खुश हुआ. So is that what you're looking at? So what are we really looking at? In faceless ITAT, I don't think that that's a very minimum alternate tax, nothing much to discuss, not of day-to-day importance so much. Okay, very well, friends. I think we can start off with question answers because I'm sure there'll be a lot to say on 45.4 and other things. We can start.
Thank you, sir. Now I'll request Nilesh Bhai Kapadia to ask his question. Nilesh Bhai, you can speak.
Yeah. Thank you. Yogesh bhai,
Hi.
I have a question on charitable trusts.
Okay.
There are some trusts which are in the process of winding down or closing down because the trustees don't want to continue the responsibility anymore. So they want to spend their corpus and come to the end of the trust. Now, in the current scenario, there is no provision for such a situation. So does it mean that for all trusts, they are expected to continue in perpetuity?
Okay. As of today, what we are doing is we are donating the money to another trust. Now, one needs to explore whether that is possible. If we donate this to another trust, then that donation may not qualify as a corpus donation. No, that if you donate to the other trust, then nothing
Out of
is
my
left in
corpus.
this trust.
But
Sorry?
I'm giving from my corpus. I'm giving from my corpus.
You are giving from your corpus. So if you are giving from your corpus, you are donating to another trust. The donation to other trust is actually application. But then at what point of time your corpus was received 20 years back? At what point of time becomes taxable? So that corpus was never taxable at the time when you received it.
Right.
Today when you are donating it, they are saying that it will not be treated as application of your income. All right. If it is not treated as application of income, I do not have any income today. I do not have any income today. So I don't need that application of income today, correct? Any views on this?
But I
Not
might
that
be
I've
also
thought
having...
about it in last.
Yeah. No, I think
I'm just thinking aloud with you, Nilesh.
I think you are given a good pointer. It will definitely means. Actually, I'm facing such a live situation, so that was the reason I maybe I will look at the numbers from that perspective which you mentioned.
Yeah. Let us look at not just the numbers. We'll have to open the act and read it again. Will it work or is there any catch? Any catch on this? Prima facie, I think this should work because this it becomes the income at the time when you receive that corpus. It doesn't become the income at the later point of time. So this is something which we may just consider. I don't know whether we'll have to sit across and do it.
Okay. And on the investment of corpus, do I need to segregate corpus fund and general fund separately? Because I might have invested in fixed deposits bearing and I'm getting higher rate of interest. And if today I was to disinvest and reinvest before 31st March, then maybe I will be getting lesser rate of interest.
Yeah, you're right. But they are saying maintained separately. So that is the requirement of the legislature. So that is the question I had raised. That maintain separately means what? Does it talk about some sort of a fund that I have to create? I will have to earmark something that okay, towards the corpus, these are the assets. Maybe the assets form may keep on changing from one form to the other. So long as it is within 11.5, there is no difficulty. So I need to maintain that. And therefore that maintenance of that means I will have to earmark that as as a corpus fund or a corpus asset, is it not? So from one fixed deposit to the other mode, that is permissible, but so long as it is within 11.4, you have to show that has maintained. But otherwise how do you meet with the requirement of maintaining it?
No, suppose I have got corpus fund of 5 crores and general fund of 1 crore, and I got entire 6 crores in one FD. Do I need to break it up and have one corpus FD of 5 crores and another general
I
FD of
don't
1?
no, no, I don't think I don't think that is required. As in when the FD matures, you can think of doing it. But I don't think you need to break your FDs for that. So long as you have identified that this six comprise of five from here and one from here. Because FD is easier. What do you do with a building here?
Yeah, yeah,
If there's a building,
yeah.
okay, so if part of the building is from corpus and part of the building is funded from my past reserves or income, then what do you do? How do you break it? So it's not possible. So I think so long as in the accounts you identify that okay, out of this is from corpus and this is from non-corpus, I think that should be good enough. You have to make the provisions workable, otherwise it will be difficult.
Okay. Thank you. That's all from my side. Janam, you can take over.
Thank you. Now I'll ask Ankit Shah to ask his question. Mr. Ankit?
Sure, thank you. Hi, sir. This is Ankit. A couple of questions I had to check with you. Uh, First is on the equalization levy. So, in the equalization levy, what they are saying is that the ecom operator, sort of, if it collects gross consideration, then that amount is included for computation of 2%. But what happens if on the platform, I just enable the buyers and sellers to meet each other, and then subsequent sort of transaction happens out of the platform like a OLX or 99 acres? Do I still say that, okay, well, I may not be aware as an ecom operator that whether they've ultimately transacted or no. So do I still say that, now I'm supposed to know that whether they've transacted and know their value and then compute sort of, 2% on that in absence of a deeming fiction like we have in 194?
No, I understand that. You see, I think if the transaction is not fructified on your platform, okay, then I don't think that there is any tax liability, because you haven't earned out of that at all. Because it is, if on your platform some transaction has fructified and you have earned, if the transaction is not fructified, then you haven't earned out of it. And if you haven't earned out of it, then I don't think that equalization levy can apply. So that facilitation, at least to the extent of acceptance of order or making of payment or those five things which they have said now, has to be there. No? If it is nothing is there, then where is the income? If there is no income, income may probably go to OLX, but income will not come to Amazon. So I don't think that that can ever be covered.
Okay. Okay. Right. And another question sort of is with reference to this goodwill. Now, what happens on goodwill is that I might have some unabsorbed depreciation brought forward. And of course, under law now, this would be called as the current year depreciation whenever I ultimately set it off. Now, of course, it's a determined depreciation because it's out of the past period. So does the department now have a venue to say that, now this is current year's depreciation because of operation of law? And sort of, I will not allow this from 1/4/2020 onwards, or is it that it's determined in my favor? So then, you have to allow it.
Okay. So unabsorbed depreciation 43(6) would say that uh, that unabsorbed depreciation is deemed to have been allowed to you in the past. If it is deemed to have been allowed to you, uh, there cannot be a contrary stand now to disallow that, because there is a deeming fiction in the section which will have to be taken to its logical conclusion, that what is unabsorbed is deemed to have been allowed. Now, if it is deemed to have been allowed, you cannot now disallow it, because the law says deemed to have been allowed and you are disallowing it. That's, I don't think that can, I mean, so I understand your question is very well taken. But because there is a deeming fiction in 43(6) which says that unabsorbed carry forward depreciation is deemed to have been allowed, I don't think it can, courts can ever allow the department to say that something which is deemed to be been allowed, I will disallow under some other method. No, I don't think so.
Just one last point to check with you is on the definition of liable to tax. Now, of course, when the treaties were negotiated, the treaty partners sort of, never had envisaged that what do you call or what should be the scope of this term liable to tax. Now, if India sort of, goes for an unilateral act of introducing this definition without consulting the treaty partners, then reading with the Vienna Convention and of course the courts giving Vienna Convention some persuasive value, do this does such definition then sort of still continue to hamper otherwise understood general interpretation of the term liable to tax?
Yeah, I appreciate this question. I think this question is very valid, but it's really a old question. The day they had introduced in section 90 the provision that the domestic I think when they introduced to that may be taxed, they introduced that provision over there. So how this may be taxed, should be shall be taxed versus may be taxed, how that should be interpreted. So the amendment brought about in the statute unilaterally. This is for the third time they have done that. So I do agree that there is a scope of international arbitration on this, or a writ petition on this, saying that this is unilateral rewriting of a treaty. But it's not going to be easy. There are several issues in that. So point is very well taken. I think something which.
Thank you, sir, for it.
Ashok Bhai Pradhan, you can ask your question. Ashok Pradhan. Ashok Bhai. Paresh Wakharia ji, you had raised your hand. Mr. Paresh Wakharia. Nilesh Bhai Patel. Nilesh Patel.
Yeah, so Yogesh Bhai ji. Hello.
Yes,
Can you hear?
Yeah.
Yeah.
Yes, I can hear you.
Yogesh Bhai, my question was maybe applicable to all. This threshold tax limit has been increased from 5 crores to 10 crores, correct? But the original limit is still states at the 1 crore. Now when assessee opt for to go for presumption as per 5 to 10 crores, the tax audit won't be applicable, correct?
Tax audit. Okay.
Yeah. But
Okay.
still the TDS provision will be applicable.
Yeah, this 5 to 10 is only those limited cases. It is not in all the cases.
So but the original limit is as per act is 1 crore. So
that continues.
So the TDS provision he is obliged to do as per the act.
5 those limited cases.
Correct.
Digital payment, etc. Whatever.
Yeah. But as there won't be any tax audit, then this question of 40A1A disallowance won't be come, as there won't be a tax audit. So can he be dispensed with the TDS provision of deducting and filing the returns?
So 40A1A, see, because tax auditor is not required to do something does not mean that the assessing officer is not required to do something. Anyway, tax auditor is doing what assessing officer is required to do, but the converse is not true. So the provision of 40A1 will continue. All those provisions will continue.
As there is no tax audit applicability, the disallowance and the following of the TDS provision that will be itself in a dual.
Of course, all the provisions will continue.
That's why we are relieved from reporting. Nothing else.
Yeah. So somebody may dispense with the provision of TDS. What I mean to say.
Yeah, right. It's not just a question of relief from reporting, but lots and lots of our chartered accountant friends will have, we'll have a problem in terms of reduction of their practice. That's flip side of this.
Yes, Ashok Bhai, Ashok Pradhan.
Yeah.
Or Paresh Wakharia ji can ask their question.
Hello.
Yeah, Paresh bhai, bolo. How are you, sir?
Bus fine. it's not about the question, right? I had some thoughts regarding 45.4 and 4A.
Wonderful. Wonderful. Please go ahead.
Some of the observations which I feel which can be noted is that,
Sure.
the section applies on a particular event. All those consequences follow at the time of reconstitution or at the time of dissolution. This is something should be noted. So those very same actions, if taken otherwise than at the time of dissolution or reconstitution, it may be arguable that it is not strictly covered by this section. More importantly, when 45.4 says that asset represented by your capital account. Now, we have Sunil Siddharth Supreme Court case, which I recollect, which said that once an asset is contributed in the partnership firm, it ceases to be the asset of the partner. It is then a common asset of the firm. So you have to first create a fiction that a particular asset of the firm can be considered as representing the capital. So that kind of a fiction has not been introduced. Secondly, you are going away from the normal principles of income taxation. So section 224 ideally should have been amended first to deem this as an income. I'm aware that they have used that word that it shall be deemed to be the income of the specified entity in the section itself, subsection itself. But whether that is sufficient, because whether this is a charging section or a machinery section. This 45.4, if construed as a charging section, then it's okay. But if it is a machinery section, then the machinery section cannot create a charge which is not created in the section 224. This is the one thought that I think we should not publicize much and alert the government in the final budget, because these crazy amendments does not require any alert to the lawmakers. But that apart, even if you see the sequence in that, the sequence is what? That shall be chargeable to tax and shall be deemed to have been chargeable to tax in the hands of the specified purpose. So you want first to make it chargeable to tax and then to say and deemed to be. According to me, the sequence is also wrong. Even if you want to make it as a machinery charging section, then it should be first deemed and then it should become chargeable. So these are all very, very technical points. Another issue that arises that how do you interpret that ultimately the tax consequences arise only when it is received. Only it is received at the time of dissolution or at the time of reconstitution. So now the question is that what if it is received before that? And or suppose in something which has been created, a revaluation which has been done 10 years back or something, right? And today when you settle your account, right, you have nothing to receive. In fact, you are in a debit balance, right? And so therefore there is nothing to receive. So technically, if you go by word, then I'm not receiving anything, and therefore the provision should not apply. Or alternatively, the way they have drafted it, that capital account shall be recalculated. So if the capital account is to be recalculated, then it's a matter of arithmetic. So therefore the negative also has to be considered. So these are some of the thoughts which I had. I think Yogesh bhai is the valued view on this.
Okay. Yeah, very nice, Paresh. But what I agree, like, but so far as your observation on 224 is concerned, yeah, can you hear me?
Hello. Yeah.
You can hear me, no? Okay, so far as your observations on 224 are concerned, we have clause 6 in 224, which says that any capital gain chargeable under section 45 is considered as income. Now here, all that they've done is 45.4, so it's part of 45. So it is already forming part of the definition of income. So I don't think that there is anything further required on that front. That is
but they have said notwithstanding anything contained in 45.1. These clauses.
So, but then, I agree.
Yeah.
But then income deemed under clause 6 of 224, it doesn't say 45.1. It says 45. Only 45.
Yeah.
So whatever is chargeable under 45 is chargeable. So that is one aspect. Other aspect, what he said is that at time of receipt, yes, that is there. I mean, that was going on in our mind also when we did this internal discussion. But there, I think we'll have to wait, because we'll have to wait for how they, make the rules for computation, etc. Because otherwise, it will be very easy for someone to withdraw the capital on one day before and thereafter 2 days.
Yes.
So I am sure that they will take care of those aspects while they draft how to do that calculation of balance in the capital account. Okay, so that is a point which probably will get covered in the rules. Other points on the drafting issues, what you said, Paresh, are right. Yes, there are. I agree that there are problems in drafting. Definitely, there are a lot. This entire 4 and 4A will have to be recasted. Asset of the firm, you said that the fiction should be created, but they are not saying that the asset of the firm. You refer to Sunil Siddharth Bhai, that asset represented by asset. See, I think asset which has been brought in by the partner definitely becomes the asset of the firm under section 14 of the Partnership Act itself.
Okay.
So it is an asset of the firm itself. There's no doubt about it. Now, asset of the firm, they are not saying that this asset of the firm is the asset of the partner. They are not saying that. What they are saying is that there is a profit in the hands of the partner. And what is that profit? The value of the asset which he gets minus the capital that he has introduced. That is his profit which they really want to tax. Okay. So therefore, I don't think a deeming fiction is required to treat that as an asset of the firm or the asset of the partner. That's not required, but as I said, those overlaps, etc. You're treating somebody's income in somebody else's hand. That is the fiction that they've created. But then whether there's an overlap, there's no overlap, all those questions will have to be dealt with. So, yeah, drafting errors are there.
Yogesh bhai, on this part, on representation, with the word for subsection 4 reads, whereas specified person received during the previous year any capital asset. So this is the case of capital asset being received at the time of dissolution, reconstitution of the specified entity, and that asset which represents the balance in his capital account. So that is why I said that as per Sunil Siddharth Bhai, right? Introduced asset becomes the part of the asset, and whatever the assets which are generated in the course of the partnership are also the partnership assets. So there cannot be.
પરેશ ભાઈ જરાક here.
हाँ बोलो साहब.
હું આમ કહું છું, it is already 1:30, 30 students are there. તમે યોગેશ ભાઈ સાથે અને મારા સાથે પછી વાત કરજો ને. આ આપણા અંડરનું ડિસ્કશન છે અને આ આપણે ગવર્નમેન્ટ સર્કલમાં એડવાન્સમાં મોકલવાની જરૂરી નથી. Otherwise they will become more wise.
Agreed. એ મેં પહેલા જ કીધું કે આને પબ્લિસાઇઝ કરવાનું નથી એમ.
નથી પણ આ થઈ જશે પછી.
હા નહીં ઘણું ટેકનિકલ છે.
મેહુલ
Yes, sir, sir.
Can you please propose a vote of thanks?
Yes, sir. We'll just do that. Before presenting the vote of thanks, just few announcements. It will hardly take a minute. Members, as announced earlier, the renewal fees for the year 21-22 is not to be paid by the members who were there for the financial year 2021. Only the new members who will be joining the study circle will have to pay the fees of 2,000 plus 300 rupees. And members, we request our juniors as well as a senior member of the study circle to kindly come forward for the position of convener and co-convener. We'll be there to help you for the next year. Thank you. Now presenting a well-deserved vote of thanks to Yogesh Bhai.
Mehul, those who are intending to take up the assignment of our study circle convenership, they should send a profile to you.
Yes, sir.
That you have not sent. Please do it. Otherwise, how will they come forward?
No, sir, they can send us an email or a WhatsApp.
Outgoing conveners have full right to decide to whom they would like to entrust the assignment after their period is over, or will send it to the secretary of the WIRC.
Yes, sir. Yes, sir. Thank you. Okay. Yogesh Bhai has presented the provisions of the finance bill in a very lucid manner, in a very detailed form. Our finance minister, Honorable Sitaramanji, she presented to us the bill of 318 pages in an hour or so, in 2 hours. But to discuss on that and to have a slides of around 80 pages and to deliberate for 3 hours, it was Yogesh Bhai's work that he has done in a very lucid manner. Thank you, Yogesh Bhai, for giving all the insights about the bill. And we hope again to meet all the members of the study circle when this bill becomes an act. So hope to see you again in a physical manner. Thank you very much, sir.
Thank you. Thank you. Thank you, sir.